One of the greatest benefits offered to military veterans is the VA loan. Unfortunately, it is also one of the most misunderstood. The VA loan was created in 1944 as part of the Servicemen's Readjustment Act, better known as the GI Bill of Rights. The intent was to level the playing field for service members who had been away at war while their civilian counterparts were settling down and purchasing homes. Eligibility requirements for the VA loan are straightforward but yet often misunderstood. You may be eligible for the VA loan if you meet one or more of the following conditions. You have served 90 consecutive days of active service during wartime, or you have served 181 days of active service during peacetime. Have you racked up more than 6 years of service in the National Guard or Reserves, or if you're the unremarried spouse of a service member who died either in the line of duty or as a result of a service-related disability. You're also eligible if you're the spouse of a service member that is missing in action or in a prisoner of war status. Now, obviously there are stipulations such as needing to have received a general discharge or better. If you received a bad conduct discharge or other honorable discharge, it can be reviewed, but this process may take months, so just don't get in trouble in the first place. The first step in getting a VA home loan is to apply for a certificate of eligibility. This confirms for your lender that you qualify for the VA home loan benefit. For veterans, this will require a copy of your discharge or separation papers, the DD-214, the coveted DD-214. For active duty service members, this will require a statement of service signed by your commander or by direction, your name, social security number, date of birth, pay entry base date, duration of any lost time, the name of your command, 2 stool staples, and a rare flower that grows in the Himalayan mountains. Okay, maybe not the last few things, but you get the idea. You're going to need a ton of information, just like every kind of paperwork you do in the military. For current or former members of the National Guard or Reserves, you will need about the same paperwork above, plus a bunch of extra crap that I don't understand because I've never even been in the reserves. Luckily, we active duty military types are used to exorbitant amounts of paperwork. Hack alert! Ask your lender if they can get your certificate of eligibility for you. If they say no, they are either not a VA lender or they are not a very good one. If you wish to get your certificate of eligibility beforehand, you can do so online through the e-benefits portal, which is linked below, but your lender should be able to help you out. There are 3 ways that financing can be obtained. A veteran may obtain financing on his or her own. A veteran and his or her spouse can obtain financing jointly. This is a useful strategy if the non-veteran has a better credit history, which is commonly the case because we like to spend money on stupid things when we're young. Or 2 or more veterans can obtain financing jointly. What is really crazy about this last opportunity is that you can actually purchase more than 4 units if done correctly. The VA pamphlet 26-7 revised states that, quote, if a property is to be owned by 2 or more eligible veterans, it may consist of 4 family units and 1 business unit, plus 1 additional unit for each veteran participating in the ownership. Unquote. Thus, 2 veterans may purchase or construct residential property consisting of up to 6 family units, the basic 4 units plus 1 unit for each of the 2 veterans, and 1 business unit. What a crazy opportunity to house hack, which is a strategy we'll talk more about in following videos. Another cool fact about the VA is that the VA loan does not have any requirement for a minimum credit score. Yes, you heard me correctly. The VA loan program does not care what your credit score is. Unfortunately, you can't get money straight from the VA, and as a result, most private lenders will have their own minimum credit requirements. The minimum required credit score is usually around 580 to 620, but as with any lending opportunities, the better your credit score is, the better your rates and terms will be, so upgrading your credit is something that'll help you forever. Low credit doesn't necessarily prevent you from getting a VA loan, but a higher credit score will mean better terms and better opportunities. The VA home loan is a primary residence mortgage. That means it is designed to provide service members and veterans a place to live and call their own. Sorry guys, the VA loan was not intended to be used for investment properties, but that hasn't stopped us from doing it. You just have to do it the right way. I'm not advocating that you do anything illegal, but you need to understand the intent and then you can use it to your advantage. You must intend to occupy the property as your primary residence for a reasonable amount of time, which is generally assumed to be 1 year. This means that after 1 year and 1 day, you are clear to move out of the property and rent it if you would like. You may find yourself asking, but what if I get orders? Don't worry, the VA home loan's a benefit. It isn't out to get you. If you get permanent change of station orders or PCS orders to move, you may do so without penalty. If you bought the house after receiving orders to a new duty station and you were on the way, and then your orders got changed last minute, you're still safe. You have to intend to own the property for a year. stuff happens and they're not going to screw you over. You're even covered if you use the VA renovation loan and it takes a lot longer than planned, so you had to move your family into another place. They understand you're not trying to live out of a hotel for a year. Now, I'm not advocating for you to try and play the gray area game with this loan product. The last thing anybody needs is for veterans to abuse the system and have this wonderful benefit go away or get stricter. Bottom line is this, guys. Qualifying for the VA home loan is simple. Just serve your country honorably for the minimum time required, maintain a moderate credit score, and intend to live in the property for at least 1 year after purchase. Again, that's intend to. The financing limitations of the VA loan. Everybody wants to know how much house they can buy without a down payment. The answer is it depends on where you live. The VA loan limits vary based on where you live and what the market is like there. In 2019, the VA loan increased from $453,100 to $484,350. There are 199 exceptions, however, where the market is even more expensive and the limit has been increased. These counties cap out at $726,525 for the purchase price. Some of these locations are Hawaii, Anchorage, Los Angeles, San Francisco, New York, places you would kind of expect. You may be thinking, must be nice, wish my VA loan could buy a $700,000 house. Don't. Remember, in many of these markets, the average home price is well above the limit. Take Oahu, for example. The median home price there is currently $782,500. That's $55,000 more than the VA limit. Luckily, you're allowed to purchase properties over the VA limit, but you must pay 25% of the difference as a down payment at closing. Now, keep in mind, a $780,000 home in Hawaii isn't usually very fancy. I want to talk about VA loan closing costs real quick. VA homebuyers can expect to pay various closing costs such as appraisals, title insurance, credit reports, survey fees, or recording fees. These costs can range from a couple $100 to over $3,500 in more expensive markets. Now, the VA prohibits veterans from paying some common closing costs. Some of these fees include escrow, document preparation, and underwriting. This helps lower but not completely mitigate closing costs. Lenders are allowed to charge an origination fee, typically 1% of the loan amount. The nice thing about the VA loan is that closing costs can be paid entirely by the seller, just like normal real estate transactions. Also, the VA allows the seller to pay the extra fees. This is known as a seller concession. The seller can only contribute up to 4% of the home sale price, or what the house was appraised for, whichever is lower. The lender can actually step in to pay for these costs through a lender credit, but this usually means a slightly higher interest rate on your loan, so make sure you do a cost-benefit analysis on this to determine if it's worthwhile. The dreaded funding fee. The funding fee is one of the few downsides to purchasing with the VA loan. Luckily, it's minuscule. The funding fee is 2.51% of the purchase price for first-time homebuyers and 3.3% for any subsequent VA loans. On a $200,000 property, this fee is only about $5,000. Now, that sounds like a lot, but when added to the loan, it only equates to $25.10 a month added to your payment. I'm okay paying an extra $12.55 a month for every $100,000 I spend if it means that I avoid paying a 20% down payment. Also, the dreaded funding fee is waived for any service member with a 10% disability rating. Ironically, this means that an active duty service member who is missing a limb, a hand, leg, an ear, whatever, will pay a funding fee because they haven't received a disability rating yet because they're still in the military. I found a flaw in the system. All right, private mortgage insurance, otherwise known as PMI. It's required on loans with less than 20% equity in the home. Therefore, anyone who pays 3.5% using an FHA loan or any amount less than 20% down on the property is required to pay PMI. Now, PMI typically costs between 0.5 and 1% of the entire loan amount annually. This means that on a $100,000 mortgage, you could be stuck paying $1,000 a year or $83.33 a month. There is, however, no PMI on a VA loan. That's correct, there is no PMI on a VA loan. Now you know why the VA loan often has a lower monthly payment, even though you didn't put a penny down on the property. This is especially painful for me to talk about because I should have used the VA loan. I got talked into an FHA loan and I'm paying $81 a month extra on my mortgage payment, which is cash flow that I could be pocketing and I'm not. So the VA loan is awesome. What can a VA loan be used for? You can buy a home, including a townhouse or condo unit, in a VA-approved project. You can build a home from scratch. You can buy a manufactured home or modular home. You can buy a multi-unit property up to 4 units, with the exception that we talked about in the last video. You can simultaneously purchase and improve a home with energy-efficient upgrades. You can refinance an existing home loan up to 100% of the home loan's value. The VA renovation loan will even allow you to wrap renovation costs into the home purchase mortgage. I'll link to that video down below. Now let's talk about the VA requirements for homes. The Department of Veterans Affairs has a list of minimum property requirements that a home must meet in order to qualify for a VA loan. These requirements are in place to ensure that veterans and military families own safe, sanitary residences. Inspectors are looking for major issues to ensure the house meets safety, sanitation, and structural integrity requirements. This includes heat or air conditioning where necessary, electricity, kitchen function, plumbing, etc. Some other requirements are that the home must provide enough space to live, cook, and sleep. Properties need clean drinking water, a water heater, and working sewage systems. The roof must be in good condition and meet reasonable future utility requirement, which is generally a minimum amount of time it should have left before needing to be replaced. Attics and crawl spaces require adequate ventilation to prevent mold. Properties must be accessible from the street via an all-weather driveway. You can't buy a termite mound or a carpenter beehive to live in. Sorry. These guidelines allow you to understand what the home inspector is looking for. Ultimately, the home needs to be inhabitable and safe for your family to own. These rules are in place to protect service members and military families. Condominiums and condo property regimes, CPRs, must be VA approved in order to qualify. Now, are there loopholes with the VA loan? There are several exceptions to the above requirements, but understand that you may need to articulate these to your inspector or appraiser and ensure that they are on board. You can purchase a property with unpermitted improvements, but the area does not count towards the value of the property, and you must sign a hold harmless letter that you understand this. The VA renovation loan allows you to purchase a fixer-upper property. Leasehold estates, which are common in places like Hawaii, can be purchased, but the term of the lease must exceed the length of the mortgage by 14 years. There's some additional loopholes, not actually loopholes, just misunderstood options with financing, but we'll cover those in a later video. Now, to discuss the VA renovation loan. This loan is just like the FHA 203K loan in many ways, but with the option for 100% financing. There's a maximum of a 100% loan to value, subject to VA county loan limits, plus the VA funding fee. Loan amounts up to $1.5 million are allowed as long as the VA guarantee or the combination of the guarantee plus the borrower's down payment is equal to at least 25% of the either sales price or the subject's reasonable value, whichever one is lower. All right, in layman's terms, you can loan up to $1.5 million, but your remaining VA eligibility amount plus the equity in the building must be at least 25% of the purchase price. Now, here are some requirements for the VA renovation loan. The minimum repair amount is $5,000. There's no maximum to repair amount. Structural repairs are permitted. Major rehabilitation, remodeling, such as the relocation of load-bearing wall, new construction, or including additional rooms, is approved. The repair of structural damage is approved. You can even conduct repairs that require detailed drawings or architectural exhibits. If the house is uninhabitable at close of escrow, repairs must start within 30 days and be completed within 6 months. The list of applicable repairs is quite extensive. There's no reason to avoid looking into this loan. As with all loans, I recommend shopping around in order to get the best rates because different lenders have different requirements. Now, for energy efficient upgrades, a lot of people don't know that there's a VA Energy Efficiency Mortgage, EEM, home loan option. This program allows the home buyer to add up to $6,000 to the loan for energy efficient upgrades. You can either do this at purchase or at refinance. The determining factor for approval is if the amount of money saved monthly by these upgrades is greater than the amount of money it'll add to your mortgage payment. For example, if you pay $6,000 for the energy efficient upgrades, that's roughly $30 a month added to your mortgage payment. If the upgrades are estimated to save you $60 a month on utilities, you meet the requirements for this program. $60 a month saved, $30 a month paid on mortgage, you're coming out on top, you're saving $30 a month. You need to understand that this means you are taking on extra debt, so be careful. But in my opinion, it is safe since you're saving more money than it costs you every month. Now, what can be financed? The answer to this question is simple. The VA loan is designed to help service members or veterans and their families purchase safe, sanitary, and structurally sound properties. However, there's a lot of intricacies that will depend on your lender. The Department of Veterans Affairs is not overly strict on lending criteria, which is great for us. For example, in Hawaii, you can even purchase in volcano zones 1 and 2. Now, I don't know why you'd want to live in volcano zone 1 and 2, and I don't even want to know what volcano zone 3 is, but there's a lot of options out there.
There are so many benefits to the VA loan, but these are some of my favorites. Number one, of course, is that it requires no money out of pocket. The number one excuse that I hear from real estate investors is that I don't have enough money to get started. So the VA loan completely eradicates that excuse because you can get away with 100% financing, which means zero money out of pocket. Now, this is great for investors, but it's also very good for just your normal primary residence home buyer because depending on your market, 20% down could be a lot of money. And the FHA loan, which is only 3.5% down, has some other drawbacks that we'll cover in a minute. I want you to think about this for a minute if you use this for an investment property. Try to imagine the return on investment from $0 down. You can't. It's infinite. Literally no way to calculate the return on even $1 back if you put zero into the property. The next is VA house hacking, which is basically taking the first point and then making it even more effective. The VA loan allows you to purchase up to 4 units. There's actually a way to purchase more than that. We covered it in an earlier video. I'm gonna bring you a much more detailed analysis of that later, but generally speaking, up to 4 units. So imagine you buy a 4-plex or even a duplex and you rent out all the vacant units and you live in one and it pays for your mortgage. Theoretically, this means that your tenants could pay 100% of your living expenses, as in your mortgage, utilities, whatever. Wait, does that mean I could buy a house with no money out of pocket and then live in it for free while I'm building equity and I own the house? Yeah. That's too good to be true. There's no way that's true. Yeah, you're right. It is too good to be true, and it does sound too good to be true, but it is a realistic possibility. And that's why this loan is so powerful. And you've got to do your research and you should definitely look into using it. Another great benefit behind the VA loan is the 100% refinance option. Most banks will let you pull cash out and refinance up to 70 or 80% of the value of the home, meaning if you own a $100,000 home, you could pull up to $70,000 or $80,000 out of that property. So if you owe 50 and you pull 80, you could pull $30,000 in cash. I hope I didn't lose you there. The VA will let you refinance up to 100%. So if you own a $100,000 home, you owe 50 grand on it, you could pull $50,000 cash, like write a check to your bank account and still own the home. That's a pretty unique opportunity. Imagine conducting a live-in BRRRR, which is the buy, rehab, rent, refinance, repeat strategy. A live-in BRRRR where you put zero money into the renovation and then you're able to pull 100% out and it may still cash flow or pay for your living expenses. I mean, that's impressive. You could get paid to own a home that you live in for free. Pretty cool strategy. But as always, make sure you run your numbers. One of the biggest misconceptions with the VA loan is that it can only be used once, and that's just false. Now, there are some stipulations, but you can reuse the VA loan. In fact, that's kind of what screwed me in the story we'll tell in a minute. The VA loan allows you to buy a property and then live in it. You have to intend to live in it for a year. But let's say your job relocates you more than 50 miles away. Well, now you can move out and live at another home, and you can use the VA loan again. And you can keep doing this until you've maxed out the maximum allowable amount VA loan, depending on your area. So, $400,000, $700,000, depends on your area. And then, you pay 25% down over that, which is just really cool, but you can keep using it. And then if you've maxed that out and you can't reuse it, you can refinance into a conventional loan with one of the houses you already own or sell one of the houses you already own, and it just kind of recycles and you can now reuse the VA loan again. But the real benefits behind the VA loan are the safeguards in place to ensure you're taken care of and your family is taken care of. The VA loan offers a level of comfort that a lot of loans don't, even though it might be 100% financed. One of the complaints a lot of people have is the strenuous inspection and appraisal periods for the VA loan, but the reality is once you get past that and you purchase the home, that's a really good thing because it means you know every minute detail of everything that's wrong with the property. The odds are very, very slim that something will come back to bite you in the rear later on because you had a very thorough inspection period and the appraisers are very good. And so you know that there's a margin for error there that may not be the case if you use kind of cheapo, non-vetted people to buy a conventional loan. The Department of Veteran Affairs will actually go to bat to negotiate for you a little bit on foreclosures. Now, I am not advocating to fall behind on your mortgage payment, but if the worst of the worst happens, Because the VA guarantees 25% of that loan, that's how you're able to get 0% financing, they don't want to just lose their money. So they are gonna, be willing to help you negotiate. And if things go super south, they have ways to still help you get out without a huge foreclosure on your record, short sale, stuff like that. And the Department of VA will actually help you with that, whereas most lending institutes are not so kind per se. Another safeguard is the vetted professionals. Your lender, inspector, appraiser, contractor, the energy efficient people, and all these people that work with your home, they've all been vetted by the Department of Veteran Affairs. So they have some requirements for vetting to ensure that you have qualified people working with you. Now, obviously, there are gonna be people who are better than others, and there are gonna be some people who fall through the cracks. But the vast majority of people that would not be someone you wanna work with for lending or contracting are gonna be weeded out by this vetting process, either through the vetting process or just because there is a vetting process and they're like, I don't wanna waste my time applying for that. So you have a much better talent pool to pull from, which means you're gonna get a better services and a better product, depending on what you're using. Another great safeguard is that the VA loan is actually assumable, which means that another veteran could come and just take over your payments. This is not necessarily the most ideal exit strategy, but let's say you buy a $500,000 house, and because of commission for real estate agents and maybe some repairs, maybe the market didn't go up as much as you thought, or you didn't live in it as long as you thought because you got orders. If you sell the house, you need to bring $10,000 to closing in order to break even, meaning that you would be kind of underwater, and when you pay commission, you're gonna be out 10 grand out of pocket. Not ideal, but it's a reality. I have a buddy out here going through that right now. What if you had another friend who had just gotten there and liked your house, and they just assumed your mortgage, meaning that they just start making payments for you and they just take over your mortgage. They don't need the down payment, they're a VA lender, all that other stuff, it's still a normal thing, you don't own the house anymore. But instead of losing $10,000 on a commission, you just walk away and they just take over your payments. And so it's kind of a win-win, because if the appreciation happens or they make more debt pay down over the next 3 years, they're gonna be taken care of. Obviously they wanna do their numbers, but you're taken care of because now you're not bringing 10 grand to closing, so you can put money into a new property. It's a very nice exit strategy when things have not gotten the way that you would like them to have gone. The VA renovation loan is amazing. The VA renovation loan is huge. You can buy a house, even if it's tear down quality, and renovate it completely and move into an effectively rehabbed and almost brand new home and still be zero down, and you can build equity by doing that. So the opportunities are endless here. And again, imagine if you do a 100% refinance later, and now you've got all your money back out for this awesome property. So there's some cool strategies that you can use to utilize the renovation loan and the refinance loan to, I don't want to say game the game, but to really, really leverage your benefit. But be careful when you're over leveraging. All right, this sounds way too good to be true. So David, there's gotta be a downside. Of course there's a downside. There's a downside to everything. The downside is not enough people know about the VA loan. Like, the biggest problem I have with the VA loan is the amount of people who don't understand it. Now, I will say, and I'm gonna divert real briefly, if you over leverage the VA loan, it can be kind of dangerous. So just make sure that you understand the market you're getting into, and as always, buy as an investment, not as just some property that you're only gonna live in for a couple of years. Like, think ahead, run the numbers. As long as that works, the VA loan is just an amazing, amazing benefit. My horror story with the VA loan starts in 2015. I read a couple books. I decided that I was just gonna jump in, take action, and I was gonna buy a duplex. I probably could have bought a fourplex, but I was gonna buy a duplex. And for those of you who've listened, the numbers worked out. It cash flows. I get a couple $100 a month. It's really not a bad deal. Here's the problem. When I asked my realtor, who was awesome, about a VA lender, her lender did not necessarily specialize in VA loans, so she didn't really recommend it. So I went, and what I did was I found a lender. I actually thought of someone who'd been pushing radio ads. So kudos to those of you who use radio. It actually was, it still works somewhat, or at least it did in 2015. And they advertised that they specialized in the VA loan. So I went and talked to him, and the guy seemed really nice and really friendly, but he told me, well, long story short, he talked me out of the VA loan. Basically, what I got out of that was that I could only use it once. And he said I could use it other times, but he mentioned that it was just a very complex problem, and he focused on the fact that the funding fee went from 2.15% to 3.3%, meaning that it would be more expensive the second time, and how complicated it was and all the stipulations. And he really kind of tried to downplay the VA loan. He basically talked me into not wasting my VA loan on that duplex, but waiting until I had a bigger property to purchase, which is all well and good, but an $80,000 duplex barely even makes a dent in my certificate of eligibility. So here I am listening, doing the thing, you know, whatever. I do the FHA loan, which is not terrible. But here's the problem is that I paid 3.5% down, which again, not terrible. But because it was less than that 20% down, I'm required to pay private mortgage insurance, which is a bummer. And like I mentioned before, that's $81 a month, which is just shy of $1,000 a year. So you figure I've owned this place for 4 years. So that's around $4,000 that I've paid in private mortgage insurance, which could have been cash flow into my pocket. And my closing costs and fees and down payment came out to just shy of another $4,000 when I originally bought the place. So in the last 4 years, that's $8,000 that I have either spent on the FHA loan or missed out on through PMI that would have been completely avoided and in my pocket had I used the VA loan. The really, really crappy icing on the cake is that the VA loan has a lower interest rate. And at the time, it was like 0.25% lower interest rate, which adds up pretty quick over time. So over the last 4 years, I've probably lost about $10,000 just by not using the VA loan, which I would like to point out is more than my car payments and more than lattes would have been and more than most of those little petty things that people tell you to focus on with your budget. This cost me more than most of those things would have. And all it was me trying to be ambitious and not having the right person to talk to. Again, this is a $10,000 mistake, roughly, and that's in a very affordable market. Imagine if that had been somewhere like San Diego, San Francisco, or Hawaii, where instead of an $80,000 duplex, it's a $500,000, $600,000 property. I can't even begin to imagine how much worse things would be. Moral of the story is, make sure you find a very solid VA lender and a realtor who works with a VA lender. The two, if you get quality lenders and realtors, can make your life so much easier. The problem is that we often go for the first person we run into or the person we know. And unfortunately, that might not be the best person to talk to. You need to shop around for lenders. You need to shop around for realtors. And really, you need to have someone there to help you out and hold your hand. Which is why if you click the link below, I have actually set up a page on my website. You go in and plug in a little bit of information. It's like 5 or 6 questions and asks you like what your name is, what market you're looking to invest in, rough ballpark, how much you're thinking you might have to spend, and timeline, whether you're thinking maybe next month you need to buy a house, 6 months, a year, or you're just curious. And what I will do is I will take all of that information, because it'll email me, and I will go out of my way to hunt down 2 or 3 realtors that I think would be a very good fit. And obviously I will look through who their lender is and all that, and as an agent, I'll vet them to my best of my ability. And what this will do for you is it'll give you a couple people to talk to and to ask questions of and to get familiar with that I've at least taken a look at to see if I would use them. Now, I'm not saying that if I would use them, they are the best person in the world, but having been burned before, I know what not to look for, and I'm gonna make sure that you are taken care of. This is an absolutely free service, and what I will do is I will then put you in contact with them. And if you have questions for me throughout the process, I'm there to help you out. My goal through this is that whether you are buying a home or you are an investor, I'm able to help you have a smooth transition and a smooth process, and hopefully 2-3 years down the road, you'll be looking at me and going, man, what a great decision it was to use that VA loan. And then I'll go, whoo, high five.
We're gonna talk about the VA loan. We're gonna explain in detail what that process looks like so that you feel more comfortable and confident when you talk to an agent and or lender, primarily lender, I guess, for VA loan, but agents are important too. We'll talk about that. And we're gonna dig through the nuts and bolts. First and foremost, choosing a lender. Now, there are some perks and pros and cons to all different sorts of lenders. I'll talk through, I'm not going to name anyone specifically, except for the company that I recommend and work with a lot. But I will kind of talk through some different things. First and foremost, it's good to shop around at the pre-qual stage and kind of ask for terms and like a basic understanding for kind of where you're going to come in at for rate and pricing. Right now, pre-qual and pre-approval are totally different. Pre-qual is like the basic, here's my info, what do you think? And pre-approval is the actual like credit run, thing. So don't do a million pre-approvals, but do some pre-quals, talk to some different people, kind of see what your options are. That'll help you out. Now, different lenders, this is important with the VA loan. The VA loan has very few real, like, hard no limit stop guideline things, right? It is pretty lenient. For example, no credit score requirement. But every bank is going to have their own credit score requirements. So some are as low as 500, others are going to be 580, 620, really depends on the lender. So I say that just to say, if a lender tells you no, you're not qualified, it doesn't necessarily mean you're not qualified per the VA loan. It means potentially that you're just not qualified per that lender's overlays or additional requirements. So you can ask them, is this a company overlay or a guideline? They may answer, or they may just try to steer you towards another product, or you can just go research the guideline, or heck, shoot me a message on Instagram and I'll point you in the right direction. But, all right, so talking to a lender. Big banks offer some perks, I suppose, because they're well known and they're trustable and yada yada, but ultimately they're slow. They often don't close on time. They have additional fees a lot of times, hidden fees. There's a lot of things that go into running a big bank, right? A big, like, corporation style bank versus like a mortgage broker or a smaller lender or whatever. Now, not all mortgage companies are created equal. So just because a mortgage company has a really good lender who understands the VA loan doesn't mean that the entire company does. Prime example, not going to name the company, but a company that a guy that I lived with for a year was a lender with, he was amazing, right? He was a veteran, is a veteran who took a ton of time to really research the VA loan, could do anything. That doesn't mean that every lender in that company is the same way, right? So kind of understand the differences. You need to find a person who is extremely knowledgeable and talented with the VA loan, more so than you need to find a company who offers the VA loan as a product, right? There are different products available, different companies, and you can search, like, some companies will do the one-time build, or one-time, I forget the official term. Anyway, basically like one-time close. Anyway, basically like a purchase of land to build a home with the VA loan, 0 down. That's a thing, but not all lenders do it. The VA renovation loan, where you can buy a house that needs to be fixed up and fix it up, that's a thing as well, but not all lenders do it. So you need to shop around for what product you're looking for, different lenders, yada yada. Personally, I recommend and utilize a few different people depending on where you're at. And if you'd like, I'll leave a link down in the comments and in the main description of the video, pointing you to a spot on my website where you can fill out a little questionnaire about kind of what you're looking for as far as like location, purchase price, timeline, whatever. And I can introduce you to the lender that I personally love in that area, because it's going to vary, right? Like I said, different companies. So in California, I have a really good friend who's phenomenal. In Texas, my buddy Chris is an amazing, amazing lender who actually runs a team of that helps coach people through VA loans and becoming really qualified mortgage brokers. And then from there, depending on where you go, Chris has an entire network of really amazing people that I will gladly introduce you to in all of these various markets, right? And then that's, so happy to do that. Shop around, find yourself a lender, right? Get pre-qualified, talk to a couple different people to see what your options are, make sure you find someone who fits what you're looking for. Choosing an agent, I know this doesn't technically have anything to do with the VA loan, but this is, having an agent who understands the VA loan will be very, very helpful compared to the opposite. So there's this stigma that the VA loan seems to have in some markets where agents and lenders will be like, oh, it's not that great, or it's not the best loan, or whatever. Wrong. The VA loan is, without a doubt, the best primary residence mortgage product out there. And if someone's telling you that you can't get that loan approved, or you're not going to be able to get a house under contract or whatever, that's not a reflection on the product, that's a reflection of them as an agent and or lender, right? So I can tell you right now that my buddy Donnie, who was Rookie of the Year 2 years ago and top 3 realtor in San Diego County this year, has closed a crap load of VA home loan properties as an agent in San Diego, one of the hottest counties in the country, through the pandemic, one of the hottest times that San Diego's ever had. And he was closing them left and right. My buddy Tobin in the DC, Maryland, Virginia area has closed 15 or 20 for people in our community over the last 2 years. Also very hot area, very hot time period. Hawaii, Austin, Dallas, Seattle. We have closed, people that I know and have introduced have closed a ton of real estate with the VA loan in all these different areas because they had an agent who knew what they were doing and understood the ins and outs and was paired with a lender who also did. If you have the right professionals on your team, this is a cakewalk. If you don't, they're gonna try to talk you out of it. Red flag. So again, same with the lenders on the agent side. If you'd like that introduction, you click that link. That form has an option for whether you'd like an intro to an agent, a lender, both. Full disclosure on the lender side, I get nothing because there's no way to do anything there. On the agent side, if you buy a house, I will get a small piece of that agent's commission. You will not pay me, they will, and it comes out of the seller's pocket. So it's a win-win, but just something I started doing once the platform grew so big that like every day I was sending 5 or 10 introductions, and finally one of my buddies was like, I could give you a small piece of my check as a thank you if you got licensed. So here we are, but nonetheless, they're phenomenal. We've closed, $40 million, $50 million worth of VA loans in the last 2 years for people in the community. So pretty sweet deal. And again, you don't pay for it. I don't get anything unless you buy a house and it doesn't come out of your pocket. So anyway, all right, debt to income with any other loan, 50% is your cutoff on the primary side. On the VA loan, there's not actually a cap on the guideline. Again, this might be something where there's overlays, but your debt to income, I've seen mid 70s, high 70s for debt to income on duplex, triplex, fourplexes that were in expensive areas and being house hacked. So it's very possible, not necessarily recommended to go that high, but it's doable. You don't have to have money for a down payment. There are some, depending on how you look at it, some people are like, oh, if you put 5% down, you pay a smaller funding fee. I don't really think that works out. I don't really think that works out in your favor because the funding fee is so minimal. You're talking $11 a month for every $100,000 you borrow. So if you borrow $100,000, I would rather pay the $11 a month than put $5,000 down, right? Because, do the math on how many months it's gonna take you to recoup the $5,000 down. Oh, and by the way, the $5,000 down will probably only take that $11 a month and move it to like $7 or $8 a month. So yeah, not worth it, in my opinion. Opportunity cost too big, invest the 5 or use it as a cash reserve. But overall, you're not gonna have to put any money down using the VA loan. That's one of the great perks because it allows you to get into a house more affordably. Kind of touched on the funding fee already. On your first use, it's 2.3% of the loan. On the second use, it's 3.6. That's added onto the note. So, and if you're 10% disabled or have a Purple Heart, it's completely waived, but that's added onto the loan, right? And it comes out, the 2.3% comes out to like $11 for every 100,000 borrowed, which is much cheaper than mortgage insurance premiums and private mortgage insurance, MIP, PMI for like the FHA or 5% down conventional loan or USDA. And it's also way better opportunity cost wise than putting 20% down on the property just to avoid the funding fee, right? Or use a conventional loan. Like, no way. VA loan blows it out of the water. The funding fee is not that big a deal. Don't get wrapped around it. I've got a ton of other content specifically about that, but I don't think it's something to really freak out about. The loan is still a better product than anything else on the market. Closing costs. You should budget 1 to 3% for closing costs. Now, with the VA loan, the seller can cover your closing costs. So let's say the house is $100,000 and you say, hey, I will give you I'll offer you $104,000. Will you give me $4,000 back for closing costs? If the seller says yes, and the house appraises for at least that 104, then you're good, right? That totally can work. It's not a guarantee though, so I always recommend that you budget the 1 to 3%, preferably 3% or 4% for closing costs, just to make sure that if anything comes up, you're covered, there's no surprises. You get like a week out from closing and realize you don't have the money to close on the house, right? Not where you wanna be. Better to budget for it and then have the seller cover it than not. Especially in like a really hot market like we've seen the last year or two, a lot of sellers aren't covering that, right? But market shifts might become very common again. One other thing that's worth noting is the VA IRRRL. So what this allows is you to, without running credit again and financials again and requalifying for a refi, after 210 days, you can do what's called a VA IRRRL. That's a VA interest rate reduction refinance loan, which basically means that if your interest rate is low enough that it saves you money, then you can just refi into the VA IRRRL and bada bing, bada boom. Now, this is awesome because it doesn't matter if you live in the house anymore. It doesn't matter if you're qualified for the mortgage anymore. None of that matters. If the house is still owned by you and it's still under a VA loan and the rate is lower, like there's a metric there where it has to be like you have to recoup the cost of refinancing within 3 years or something. Like there's a specific, like you're not allowed to do it unless it actually saves you a certain amount of money. And then as long as it saves you that certain amount of money, you can do the VA IRRRL. So it's sweet. So like in 2020, people who had bought a house in 2019 and the rates plummeted got to use the VA IRRRL to refinance. I was helping friends refinance properties that they had moved out of. A buddy of mine, stationed in Japan, had a property in the DMV, like DC, Maryland, Virginia area, and it was a rental, and used the VA IRRRL, lowered his rate to like 2.5, 2.25, whatever, while living overseas, and just increased his cash flow on that property. So it's an awesome product, but what it also does, and a lot of times people don't think about this, is rates right now, this is July of 2022, are higher than they were in July of 2021, and people are kind of spooked about it. So there's two ways that you can go about this. You could just not buy and hope the rates come back down, and if they do, great, and if they don't, well, then you're screwed because you should have bought now. Well, that's all well and good, but with the VA loan, what you can do is you could buy today, and if rates go up, then who cares because you locked in that rate because you bought today. And if rates do go down, then you just use the VA IRRRL. So you make the payment for 210 days, refi into the lower rate, bada bing, bada boom, you're golden. So it's a great hedge in which you can only have your rate go down, it will not go up. So if you're on the fence about using the VA loan, I encourage you, go ahead and do it. If the rates do go down, use the VA IRRRL. If the rates do not go down, then you're better off having bought now than you are when rates go up another 1 or 2%, or 3, or 5, or 10, whatever, right? No one knows what the market's gonna do. So that's my thoughts on that. I mean, the basic process is simple. You talk to a lender, you get pre-qualified so that you can look at houses and whatever. Once you're getting close to writing an offer, you get the actual pre-approval done once you've picked out what lender you're going to use, and then you go through all the documents that they're going to need. There is a lot of red tape whenever you use primary residence mortgages like the VA loan. That's just the nature of the beast because it's federally backed by, like the government's guaranteeing 25% of your loan. It's not the lender, it's the underwriters and all this. So be a little patient because they're gonna ask for something, then they're gonna ask for something else, then they're gonna ask for something else, and some of it's ridiculous and some of it's stupid. To put this in perspective, I own, at the time, last July, I owned $3.5 million worth of real estate, 100 doors, cash flowed, financially free, whatever. My tax returns showed a loss because of depreciation and it's just how the game is played. And not a loss per se, but just not a lot of income. I was leaving the military, so I wasn't gonna be able to use my military income to qualify for the VA loan. So while I make more money than my spouse, I was dragging us down on the VA loan. I had to gift my wife 5% down to buy this house so that we could use a 5% down conventional loan with only her name on it so that my finances were not involved at all in order to qualify for the loan. So here I am with a bank that will lend me literally millions of dollars for real estate, telling me they can't lend me on this property because it's a VA loan. So that's how wonky sometimes primary residence is, and I wouldn't have been able to get approved for an FHA or a conventional or a USDA because of the exact same thing. So just know they're gonna ask you for some weird things, and it's, it is what it is, right? That's underwriting. You go through, you talk to them, blah, 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 you show up with closing costs, you buy the house, right? That's pretty much it. Now what to look for in a lender and an agent. Somebody who understands the VA loan, is confident, and has proven that they can get you approved. But on the loan side, rate is not always king. Don't get me wrong, there are, again, you can do the VA IRRRL later, and you can do that with another company, right? It doesn't have to be the same company. So I would rather work for a really, really good lender who will stake a claim on closing quickly and efficiently and on time and doing the right thing and actually succeeding than banking solely on rate. So prime example, when my buddy was working with this company, now he's a 7-figure wholesaler and a flipper, but when he was working with this company, people would shop and they would get better rates and they would go and then they would come back. because of the service or the inability to close. We were saving loans from other companies left and right, including companies that specialize, quote unquote, in VA loans and are military real estate lenders and whatever, that weren't able to get it done, and he was, right? And to point, I've seen him close a loan in 14 days, the VA loan. He was willing to guarantee a 17-day close or a 21-day close or whatever to get those loans done. Like, he would literally, I've seen him make a phone call and say, yeah, hey, this offer just got submitted. I'm doing the loan. I guarantee you we can close in 17 days. And if we don't close for any reason on my end as the lender, I'll pay you a per diem, which in San Diego is like $240 a day, every day until we close, right? And I don't think he ever paid the per diem. So get you a lender who's that confident and will over communicate and make sure you're taken care of. And then if the rate is, you know, a quarter of a point higher, it's better than not getting the house. And you can just do the VA IRRRL down the road if rates are still low or lower, right? Like, it doesn't matter. A quarter of a point is peanuts on most loans. So yes, getting a low rate is good. I don't think it's the most important aspect.
I see service members and veterans get burned all the time by unnecessarily high closing costs and fees. So know this, it is entirely possible for a lender to give you a great interest rate and still be the worst loan option because of these fees. Now, that is why you need to know what you're looking at when it comes to receiving loan closing costs and documents. So first off, what are closing costs? Closing costs are the myriad of fees that you pay when finalizing a mortgage. Now, anytime you purchase a home or refinance, you will be subjected to paying closing costs, unless of course you get the seller to pay them all as a part of your negotiations, which is possible. Now, how much are loan closing costs, right? So they're generally going to range between 2 and 5% of the loan amount. So on a $100,000 mortgage, you'd be looking to pay between $2 and $5 grand for closing costs. The most affordable way to cover your closing costs is to pay them as a one-time expense, right? There are times where you can wrap the closing costs into the loan in order to finance them, but then you're going to be paying interest on them for the entire duration of the mortgage. So you know, that's more expensive, but it might be worthwhile if you didn't have the cash for closing costs, or you couldn't negotiate them out of the sale, and then financing them was still, like, you'd still cash flow. It might not be as great a financial decision long term, but you know, it is what it is. Now, sometimes you can negotiate with your lender, or you can shop around with different lenders to lower your potential loan closing costs. My favorite way to lower closing costs, though, is to convince the seller to cover some or all of them. For example, let's say you have a home on the market for $100,000, and I offer you $10,000 under the asking price, so $90,000, and then you counter back at full price because you think it's actually worth $100,000. I may agree, but then say, hey, but I want you to cover all the closing costs by doing this. And by doing this, I'll have a little more on the mortgage than my original offer, but I won't have to put nearly as much money down, so the numbers could work out for me better. Now, when do you pay closing costs? You will pay the loan closing costs at the end of the loan process, otherwise known as closing day. These costs can be prepaid at closing or wrapped into the loan depending on what fits your financial situation the best. There are recurring and non-recurring closing costs. So recurring costs are those things like mortgage interest, principal interest, taxes, insurance, annual fees, and any costs associated with the loan that is paid continually throughout your ownership. The first of these is mortgage insurance fees, right? So mortgage insurance is required on any loan that you pay less than 20% down for, with the exception of the VA loan. Another reason the VA loan is incredible. Now, sometimes the first year of this fee is paid up front, but more often than not, private mortgage insurance with PMI is tacked on to your monthly payment. If you use an FHA loan, you'll also be required to pay a mortgage insurance premium. So, you know, just make sure you're aware of that. Now, they're all fairly standard fees. Just make sure you understand what they are up front from your lender. You're always going to have to pay property taxes, annual fees, insurance, whatever. Just make sure you get with your lender and you understand what those look like. So property taxes, your lender may require you to pay 1 or 2 months of them up front when you close on the property. But either way, you're going to be paying property tax for the duration of ownership, unless you're in like a state that waives them for disabled veterans or something like that. Annual assessments. So if you're purchasing a condo or a property with a homeowners association HOA fee, they may require annual fees or monthly fees. In fact, I don't know any HOA that doesn't have some kind of fee. So just know that you need to be aware of that. Homeowners insurance premium. Your lender may require you to carry homeowners insurance on the property to protect their investment. In fact, I'm pretty sure they will. As you can expect, these insurance fees are recurring for the duration of ownership as well, because you're insuring the property. And then non-recurring fees. In case you can't put two and two together, I'm looking at you, Marines. You have probably figured out that non-recurring fees are in fact not recurring. These are the loan closing costs and fees that you pay up front and you should never have to pay again, right? So the first one is property related fees. This is things like your home inspection. Whenever you go under contract on a property, one of the first things you do is order a home inspection to make sure that your investment is a good investment. Most lenders actually require this, but it's a good practice to order a home inspection regardless until you get really familiar with what you're looking at and you're comfortable with assuming that risk, right? I don't recommend that right off the bat. Before lending you hundreds of thousands of dollars, the bank wants to ensure that the property is structurally sound. You should too. So inspections will vary based on what kind of property it is, and how big, but they're generally average between $300 to $600. Next up is the appraisal fee. Lenders also want to confirm that the property is actually worth at least as much as you're paying for it. So for this reason, you will need to hire an appraiser anytime that you apply for a loan to purchase a home or refinance. Loan-related fees. These are the fees that lenders have more control over, but they can fluctuate a little bit. So there's things like the application fee, which is used to cover the processing, the cost of processing your request or your application for a new loan. So that's going to cover the costs associated with like your credit checks, your administrative requests, and whatever. Obviously, these fees will fluctuate based on the lender and their processes, but the fee is basically just passed through to you so that the lender doesn't have to pay any fees associated with processing your application in the chance that you don't actually qualify for a loan or even use them. So yeah. All right, the assumption fee. This only comes into play if you're assuming the seller's mortgage, and if applicable, this fee would be based on the value of the remaining mortgage balance that you're taking over. And then there's prepaid interest. So let's say you close a loan on January 15th, but the first mortgage payment isn't due until March 1st. In this scenario, the lender will most likely charge you up front for the interest that occurs between the day you closed and the first monthly payment, rather than tacking it onto the first payment. Now, loan origination fees is the next one, and this can be a beast, so you never know, right? These are also known as the underwriting fee or the processing fee or sometimes the administrative fee. In essence, this fee is one of the ones you really need to pay attention to, because this is one of the fees that lenders can tweak, they can overcharge for, or hide expenses to give you a lower rate, so that you, in essence, they could lower your rate, put a bunch of stuff into your origination fee, like buying down points or whatever, and they might be able to hide it there. I've seen it. You should expect to pay between 0.5% to 1% of the loan cost in origination fees, or like $500 to $1,000 on a $100,000 mortgage, right? Now, attorney's fees. Your state may require an attorney present at the closing table, and that would be another fee associated with their time. So the number of hours the attorney's at closing will determine how much this costs. And then there's a mortgage broker fee. So if you work with a mortgage broker to find a loan, instead of with a direct to seller lender, they'll often tack on this fee as their commission for help with helping you find the loan. So this commission generally ranges from 0.5% to 2.75% of the home's purchase price, and that's something you should iron out before working with a mortgage broker. Also, when you're going to work with a broker instead of like a direct to seller, be aware that brokers often take a little longer to process loans, and it's not their fault. It's just that they have to work within the confines of whatever wholesaler they find, instead of having like everything lined up in their system where they control the pipeline. So it's kind of a normal thing. Discount points. By paying discount points, you can reduce the interest rate you pay over the life of the loan. Sometimes that's absolutely worthwhile, and sometimes it's completely unnecessary. It's going to depend on the size of your loan and the interest rate you're qualified to lock in, and whatever. So one discount point equals 1% of the cost of the loan. So if you pay 2 points on a $100,000 loan, then you will be paying $2,000 to buy down that loan interest rate. So that's going to make more sense the longer you plan to stay in a home. So the longer you plan to stay in the home, the more valuable buying down the rate generally is. And then there's title fees, which are what the title company will charge to ensure that you purchasing a home with clean title. Now, the lender is going to require you to run a title search and probably get title insurance. I recommend it anyway. and that's just for qualifying for their loan. But title search fees. Title search is conducted to ensure that the person selling the home is the legal owner. Right now, I am currently dealing with a home that I'm under contract on. I wasn't able to close on Friday because the person who owns the home had tried to seller finance it to somebody else, and they need to quit claim it back into his name to sell it back to me, and that hasn't cleared yet. So the title search and everything is there to protect me. It also verifies that there's no outstanding claims or liens against the property, so that can be fairly labor intensive depending on how well kept the real estate records are. Title search fees generally hover around $200. It can vary around the title companies in your market, so just take a look. And then there's owner's title insurance. You'll probably want to consider paying for title insurance to protect yourself against any issues that arise with title after closing. It's rare that these issues will arise, but you never know, and title insurance is not that expensive, generally like 0.5 to 1% of the purchase price. So it's definitely worth looking into. Lenders title insurance. Most lenders are going to require a loan policy which protects them in case there is an error in the title search. So if lenders want it to protect their investment, you probably should. And then here's kind of a summary of mortgage closing costs. So here's an average breakdown. Again, it's average, and this is going to change based on years and all kinds of in market and all kinds of stuff. But and lenders. But here's kind of the average of what to expect. The appraisal fee, $300 or $400. Home inspection, $300 to $500. Application fee varies. Assumption fee varies. Attorney's fee, hourly. Depends on how long they're there. Prepaid interest, it's going to be based on the loan amount. Origination fee, about 0.5 to 1% of the loan. Discount points, 1 point costs 1% of the loan amount. Mortgage broker fee, 0.5 to 2.75% of the loan amount. Mortgage insurance application fee, it's going to vary. Upfront mortgage insurance, 0.55% to 2.25%. FHA, VA, and USDA fees, 1 to 3.3%. Property taxes, 2 months worth. Upfront HOA fee, it's going to vary on your homeowner's insurance. Depends on the home value and the location. Title search, about $200. Lender's title insurance, varies. Owner's title, insurance, 0.5 to 1% of purchase price. Look, junk fees. You need to avoid junk fees or garbage fees that are tacked on to most mortgages. There isn't any way to completely ignore these fees, but you can at least minimize them most of the time. So look for unnecessary processing and documentation fees in the below categories, right? So application fee, mortgage rate lock fee, underwriting fee, broker rebate, loan processing fee. Just make sure that you're aware if there's some large inflations there and then your interest rate is still low. The bottom line is this. You owe it to yourself to scrutinize the closing statement and all of your loan closing costs and fees. You need to know exactly what you're paying for and how it's going to compare to other lenders in your area. Now, I'm not advocating for rate shopping lenders after you've worked with a lender, with them for weeks on end, but I am saying you need to make sure that you aren't getting bent over by the lender at the same time. A lower interest rate doesn't always mean a more affordable loan. Make sure you look at everything objectively and not just the interest rate. People get so wrapped around what their interest rate is that they neglect the fact that the fees may be a lot more. So look at the APR, look at the fees, make sure you're comparing apples to apples. I have a roommate who does VA loans, and I have watched people go with another lender for a worse loan product that just had a lower rate or whatever, and they thought it was a better thing. And it's so frustrating because it's like, this person's getting screwed. They don't even know it. And often it's even more frustrating because like this guy spent weeks working on your thing. I've even watched where like he's walked them through all the mistakes that their lender went with, and then they still go with the other person. I don't understand. So just make sure you're getting the best deal for yourself, and remember that relationships are important. So make sure you make good decisions. Have you ever wrongly heard that you can only use the VA loan once? In my longer article and series of videos about the VA loan, I tell how I have missed out on over $10,000 due to a lender talking me out of using the VA loan because he said I couldn't use it more than once or whatever. Like it was just, yeah. These are the most common justifications you can use to buy a second home with the VA loan. Moving due to work, whether that's a PCS or after the military. The Department of Veterans Affairs understands that you will get moved around a lot while in the military. For this reason, you are able to use the VA loan again when you PCS. The same holds true if you are out of the military and you get relocated due to your job, assuming you move over 50 miles away. Obviously, if you quit working at McDonald's and then begin working at Burger King in the same town, You cannot buy the home next door to your current home. The intent of the VA loan is to help service members get into homes, not buy entire neighborhoods for 0% down. The second reason is upgrading to a larger home because of a growing family. If you have more kids on the way, you can upgrade to a larger home. For example, if you live in a 2-bed, 1-bath and have a second or third kid on the way, in this instance, you would be able to use the VA loan again in order to upgrade to a 3 or 4-bedroom home. A third reason is purchasing a smaller home due to financial distress, divorce, or loss of dependents. If you find yourself unfortunately in financial distress, divorced, or with fewer dependents for whatever reason, then when you purchase the current home, you can purchase a smaller home to downsize your costs. I hope you never find yourself in any of those situations, but it is nice to know that you can downsize to provide a lower cost of living for yourself. Fourth way is after selling the first home you purchased with the VA loan. Now, this one's straightforward, but if you sell your home, you can buy another home with the VA loan in your area. Ta-da. The fifth way is after refinancing your home into a conventional loan or out of the VA loan. So you're also able to refinance your home into a conventional mortgage once you have enough equity in the home, generally 20%, but that differs from lender to lender, right? Now, if you refinance out of the VA loan, you are free to use it again in your area. Now, there are some other stipulations, right? So the bottom line is that if you can articulate why you need to use the VA loan a second time to your lender and they sign off on it, then you'll be in the clear. Now, that being said, don't lie to your lender to game the game on this front, right? Mortgage fraud is a real thing and a federal offense, so don't get wrapped up in it. Just stay away, right? You should absolutely maximize your VA loan benefit, but do it ethically. Now let's talk about this pesky entitlement issue, right? So when you use the VA loan for the first time, there's no longer a limit to how much money you can borrow, depending on bank overlays, right? And your personal finances. That being said, for any subsequent purchases, you still have to worry about the VA loan entitlement amount. Now, this can get a little complex, so hang on tight, but I'm going to try to make it as simple as possible. Now, the Department of Veterans Affairs guarantees 25% of the mortgage amount. That's how you can get in 0% down, because the VA is effectively saying, we guarantee that they'll pay this, or we will if they don't, right? Now, if your certificate of eligibility, COE, shows that you have $100,000 worth of entitlement remaining, then you can purchase a home for $400,000 with 0 down, or more, provided you are able to pay 25% of the amount of money you go over your remaining entitlement. For example, if you bought a $500,000 home with $100,000 worth of entitlement remaining, you would need to pay $25,000 down. $100,000 eligibility equals $400,000 purchase plus 25% down towards the extra $100,000 that you're borrowing for this $500,000 home. Hope that made sense. The COE entitlement limits will vary depending on where you live in the nation. Let's talk about how your first VA loan affects your entitlement. Let's say that your first VA home loan was $200,000, which means that you used $50,000 worth of your COE. If you're looking to purchase your second home in San Diego County, where the 2021 VA loan limit is $753,250, you will have a remaining COE of $138,312.50. which would allow you a maximum purchase price of $553,250 before you would need to be required to put any money down. So run that back, $753,250 is the local entitlement amount. Divided by 4, because they're only covering 25%, that's $188,312.50 COE, right? Then you take out the $50,000 entitlement that you used on your first home, right? The one that was $200K that you already bought. That gives you $138,312.5 in remaining certificate of eligibility, like entitlement, which means that if the VA covers that amount, you could borrow $553,250 in purchasing power, and then anything over that, you would have to pay 25% down for every additional dollar borrowed. One-time entitlement recoup. So look, if you sell your home, you can recoup your entitlement once. It isn't an automatic process though, so like some people believe it is. So the restoration process needs to be done by the veteran, and the paperwork can be done online or by filling out a request for COE, right? The VA form 26-1880. And then you take that to the regional VA processing center. Now, residual income. So when you move out of your first residence and decide to rent it out, 75% of the gross rental income can be counted towards your debt to income ratio. Now that's a nice touch because it means that your first home will actually help you qualify for the second mortgage, or for the mortgage on your second VA loan purchase, as opposed to hurting your qualifications. The best thing you can do here is ensure that the rental income you generate covers the mortgage payment on your first home. Ideally, you want it to cover all of your expenses, but at least make sure it covers your mortgage. This is why you need to buy your home as an investment instead of just a home. The bottom line here is that the VA home loan is an incredible benefit, and you should definitely take advantage of it more than once. Using the VA loan to house hack is my personal favorite method for beginning your real estate investing journey, and I hope you will take advantage of it. Yes, you can use the VA loan multiple times. There are stipulations surrounding your specific situation, but you can use the VA home loan more than once. Now, I hear all the time people still saying that you can't use the VA loan more than once, and still saying that there's a limit on your first purchase. And just, there's so much misinformation out there about the VA loan because people just pass down what they've heard instead of doing some research. So I would just ask that if you got some value out of this, share this with someone. If you hear someone say one of those things, share this with them, or just share it on your Facebook or wherever, or pass it around. Help service members and veterans understand you can use your VA loan more than once, how to use your VA loan more than once, and that you can buy more house than you might think. There's a lot of misunderstanding and misconceptions about the VA loan, but it's incredibly powerful if used correctly. Overthinking the VA loan funding fee. The VA loan is one of, if not the most incredible financing options on the market, and yet people still try to find reasons to complain about it. It drives me nuts! You talk yourselves out of using the VA loan because the funding fee is terrible. Or you convince yourself that you need to put money down to buy down the funding fee because it sounds terrible. It isn't. So I'm gonna break down my thoughts on the VA loan funding fee here because I get asked this question all the time, and I just realized that there's a need for this breakdown to be in existence. First and foremost, what is the funding fee? The funding fee is essentially an origination fee, just like other lenders have, that is used to help keep the cost of the loan for U.S. taxpayers lower. Because the VA loan doesn't require down payments or monthly mortgage insurance, this is kind of a requirement. It is what it is. So the funding fee is wrapped into your mortgage, and it's paid when you close the VA home loan. This funding fee is a downside of the VA loan, but it really isn't that bad. So on a $200,000 property, the funding fee is only like $4,600. Assuming you were to pay 4% interest on the loan, this funding fee could cost you a whopping $22 a month. So in my opinion, paying $11 a month for every $100,000 in loan amount is absolutely worth not putting 20% down in order to use a conventional mortgage, right? So home loan funding fee amounts differ, but you know, it is what it is. It's 2.3% for your first use and 3.6% for your subsequent use if you put no money down. If you put 5% down, it's 1.65, and if you put 10%, it's 1.4. So really not enough of a savings there to justify having to put $5,000 or $10,000 down per 100,000. Now, funding fee amounts for other VA home loan types, like the IRRRL is a 0.5%. Manufactured home loans, right, like a mobile home, it's a 1% funding fee. If you're assuming a VA loan, it's a 0.5%. If you're using the Vendy loan for purchasing like VA acquired property, it's 2.25%. If you're doing like a Native American direct loan, a NADL, that's 1.25 or a 0.5% for your subsequent use. And if you're doing a VA-backed cash out, it's the 2.3 for first time and 3.6 for, and I'll put a table in here so that that looks better, but, or you can look at the article. Now, circumstances that waive the funding fee, right? So the most commonly known way to avoid paying the funding fee is if you have a VA rating of 10% or greater for your disability rating. That said, there's several other ways. I went ahead and just copied it straight from the VA Gov website because it's really just a good breakdown, right? So you won't have to pay a VA funding fee if any of the below descriptions is true. If you're receiving VA compensation for a service-connected disability, or eligible to receive VA compensation for a service-connected disability, but you're receiving retirement or active duty pay instead, or the surviving spouse of a veteran who died in service or from a service-connected disability, or was totally disabled and you're receiving dependency and indemnity compensation, DIC, Duke, or, couldn't resist, or a service member with a proposed or memorandum rating before the loan closing date saying you're eligible to get compensation because of a pre-discharge claim, a service member on active duty who before or on the loan closing date provides evidence of having received the Purple Heart. You may be eligible for a refund of the VA funding fee if you're later awarded VA compensation for a service-connected disability, right? So you just gotta ask that question. Now, the effective date of your VA compensation must be retroactive to before the date of your loan closing if you think you're eligible for a refund. If you think you're eligible for a refund, please call your VA regional loan officer or whatever at 877-827-3702. All that's on the article, right? So they're open and they'll be happy to talk to you. So why is the VA loan funding fee better than using the FHA loan? If you focus on the negative view of, but the funding fee stinks, you'll somehow come to the conclusion that the FHA loan could be your better option. And let me just tell you that this is dead wrong, right? I got talked into using my FHA loan to buy my first duplex by my lender, nonetheless. And that has cost me well over $10,000. And if you watch some of my other VA videos, you'll figure that out since closing on the property. The VA loan is much better. The first reason is mortgage insurance premium. The FHA loan requires that you pay a mortgage insurance premium, which is 1.75% of your loan amount. So right off the bat, on the $200,000 home example, this is $3,500. So keep in mind that the funding fee is not charged up front, but rather wrapped into the loan and paid down over the course of the mortgage, right? So that $3,500, the MIP, that's up front. Now, there's also private mortgage insurance, PMI, right? So to make matters worse, this PMI is added to the FHA loan as a sort of ongoing mortgage insurance premium. This PMI ranges from 0.45% to 1.05% of your original mortgage amount, depending on the amount of your loan. So on our $200,000 home, the PMI would be 0.8% or $1,600 annually. This loan, on this loan, PMI would equate to $133.33, and then a whole bunch of other threes, a month added onto your loan payment. So here's a short down and dirty comparison of the difference between the VA funding fee for the VA loan and the mortgage insurance premium and PMI payments on the FHA loan on our $200,000 example. So with the VA loan, you would have taken the funding fee and you would have it wrapped into the mortgage. You would pay $0 up front on it and roughly $22 a month for the duration of the loan, totaling $4,600 over the course of the loan. With the FHA loan, you would pay the $3,500 mortgage insurance premium at closing, and then you would be responsible for paying $133.33 monthly in PMI in addition to that, right? So, and after just 1 year of ownership with the FHA loan, you would have paid $5,100 between MIP and PMI, and you'd still be on the hook for $1,600 a year in PMI expenses until you got below that 80% threshold. Oh, and by the way, try to convince your lender to waive the MIP and PMI expenses on an FHA loan just because you have a VA disability rating of 10%. Let me know how that works out for you. They don't care. The VA loan is $0. The only way to get rid of MIP and PMI expenses is to put a lot more money down than you want to, right? Like if you put 20% down, you probably wouldn't have these, but why would you do that if you're trying to use one of these low down payment options, right? Like it doesn't make sense. It's kind of counterproductive. So again, the funding fee isn't that bad. The VA loan is an incredible benefit for service members. All right, so why shouldn't you worry about the fee? The bottom line is that the funding fee does cost you a little bit of money, and it does get wrapped into your mortgage. It might mean that the VA loan is not a perfect, zero down, no money, nothing ever, wonderful, whatever, but someone's got to make some money, right? Like there's got to be something for this benefit. So it doesn't, however, ruin the VA loan. I hear negative people comment about, oh, but the funding fee sucks all the time. And the reality is that the funding fee is substantially better than what you would pay on other affordable primary occupancy loans. Personally, if I was to buy our $200,000 example house, I would much rather pay $22 a month than have to cough up $40,000 as a down payment. Now, I say that without even going into the concept of opportunity cost and the present value of the money, but just for sake of argument, if you had the money for the $40,000 down payment, you could stick it into even just a crummy savings account, just a savings account. And as long as you earned 0.0066% interest, you would earn enough interest to cover the funding fee cost. My bet is that you could invest $40,000 almost anywhere for more than 0.0066% return on your investment, which is exactly why you should not complain about the funding fee. It is chump change. Like, who cares? Now, I would like to throw this disclaimer out there real quick. I'm not licensed in any capacity to work with mortgages. I just do my homework. I also did this math on a desktop calculator, so if the numbers aren't perfect, they're just rounded, whatever, I apologize, but you get the idea, right? And that's the point, is getting the idea. Also, these fees do change from time to time. How to qualify for a VA loan without income, because your income will end as you're exiting the service. For example, if you're getting out of the military in 6 months, your lender's not going to be able to use the income for the military service income to qualify you for the mortgage. Puts you in kind of a weird spot, because if you were planning to buy a home as soon as you move back to your home of record after exiting the military, you know, it might not be as convenient as you want. So this video has been a long time coming, and I have no idea why I didn't record it sooner, but now I have more information. I want to help you guys out, and I want to give this all to you, right? So now I hope this video helps give you some ideas, but just know going forward that the answer isn't as simple as you would hope. So the first is VA disability income. Now, I listed this one first because it's common these days for service members to receive disability income. So did you know, and you probably didn't, but if you didn't, VA disability income actually counts as 1.25 times the amount you receive when factoring for debt to income ratios, right? So just to make sure that this is clear, that's right. If you earned $1,000 a month in disability income, your lender will actually count it as $1,250 a month. Now, the reason is that your disability income is tax exempt, and so they count it as what the equivalent pre-tax ordinary earned income would need to be in order to net your disability income amount, right? Now, I've seen veterans qualify for mortgages based solely off of their VA disability income, including a $400,000 and some change home in Texas, I believe, with a veteran who was 100% disabled. So totally possible. Number 2 is retirement or IRA distributions. This one's fairly straightforward, although I don't believe it'll apply to the bulk of our younger audience. If you receive a pension or distributions from your IRA or 401k or other retirement vessel, that can count as income that you can use towards qualifying for your loan as well. Number 3, spouse income. So this is another one of those obvious answers, but people don't always realize that you can utilize it. Your wife or husband has a job. You can use their income toward qualifying for the loan. For example, my wife is a high school counselor, and she has been for the last 2 years. Actually, she has like 13 years experience, but at this specific school. When I exit the military, I could utilize her income to improve my debt to income ratio when qualifying for a VA loan. So as long as we qualify with her income and not mine, then none of the rest of this matters. So that's one advantage of if you wanted to like send your spouse back home to get a job prior to exiting the military, they would have that record of income. Although I have done this in just about the last 2 years of my time on active duty, and I don't recommend it for a quality of life standpoint. So financially, logistically, like it kind of makes sense, but from a quality of life standpoint, not ideal. Miss my family, so you know. Number 4 is one that I get asked a lot about, but get a job offer letter. So if you have an official job offer letter to begin employment with a company upon exiting the military, you can use that income towards qualifying for the VA loan. This will show continuity between your current income and the income you will be receiving upon exiting the military. This letter needs to be official, show the salary you'll be receiving, the date you'll be starting employment, location of the job, and any other pertinent information regarding your situation. Anything that isn't regular W-2 income cannot count towards that income. That means you can include your salary or hourly wage from this job offer, but not anything commission-based or related to bonuses you may receive, because that's not guaranteed. Please note that you're going to want to talk with your lender to clarify exactly what they want to see in this letter and ensure that your employer is legit. The last thing you want to do is use income from a job that you aren't actually going to be working and then wind up getting foreclosed on because you can't afford to make your mortgage payments. Number, I think we're on 5 or 6, I've lost track. 75% of your gross rental income. Now, this is one of the reasons that I love house hacking so much. Let's say that Jimmy buys a 4-plex and the market rent is $1,000 per each of the units in the house. The house that he's buying, right? Now, because Jimmy plans to live in one unit and rent the other 3 out to tenants, he can use 75% of the $3,000 that those units can reasonably be expected to rent for towards his mortgage payment. In this specific scenario, Jimmy can count $2,250 worth of the rental income, 75% of $3,000, towards his debt to income ratio. Now, the catch here is that this $2,250 only counts towards the mortgage payment. Any of this rental income that is left over after being used towards his proposed mortgage payment will not count towards debt to income ratio. It'll just kind of disappear. So just to clarify that, it counts towards your principal, interest, taxes, insurance, PITI, not just the mortgage payment itself, but your PITI. So, you know, it's very useful, but just keep that in mind. The next, maybe 8, I don't know. Cosign, 12.5% down. Contrary to popular belief, you can partner with a non-veteran or non-spouse to use the VA loan. The downside is that the other person will need to bring 12.5% down to the closing table. That being said, 12.5% down is still better than 20% down, so this could be worth their time. Although personally, I wouldn't pay 12.5% down for a primary residence when there are other options like the FHA loan or even a 5% down conventional loan, which is less for owner occupied, right? So those are probably better options. The only real situation I see this making sense in is if your partner has the 12.5%, but not very good credit or other reasons that wouldn't be able to qualify for the loan on their own. The caveat here is that I don't know if I would want to partner on a home with somebody who wouldn't be able to buy the home on their own for financial reasons, right? So, you know, that's still an option nonetheless. Now, the last option, I think this is the last option, if I remember correctly, that I put on here. I think we're on 8 now. Partner with another veteran. Now, you most likely put 2 and 2 together when I mentioned partnering with a non-veteran, but yes, you can partner with another veteran as well. I have a couple of friends who have done this, and one set that did it specifically for this reason. One of them makes a lot of money, but it's in a new job and didn't show the income on the tax return yet, and since it was commission-based, it has to be on the tax return. The other had a tax return to back up their income, and so they collaborated to purchase a badass triplex in San Diego. Now, there are several situations in which it would make sense to purchase a property together, but the most common two I have seen is when one member cannot show income required to purchase, or they want to combine their income in order to qualify for a larger property. Again, remember, tax returns need to show income. So in order to crush the income requirement, the best thing you can do is have tax returns for the last year or two showing your income. One of the things a lot of service members do is try to get as close to zero on their taxes, and this is not just service members, this is everyone, especially like real estate investors. And while it's great from the standpoint of paying taxes, it does nothing to help you when qualifying for a loan. So if you're self-employed or like a real estate investor and you're showing almost no income for taxing, it's gonna bite you when you try to qualify for this loan. So let's say you brought in $80,000 in rental income last year, right? After all the expenses, you showed a net cash flow of $1,000. Then you're only going to be able to use $1,000 towards helping you qualify for the loan you're applying for. While you want to save money on taxes, just make sure you do it in a way where you still show enough income to qualify for a loan if you need it, right? It's kind of a delicate balance. Now, for this reason, it is sometimes best to bite the bullet and show some taxable income in order to showcase that your business is actually making money. That might be painful from a standpoint of paying taxes. It can be quite beneficial for qualifying for a loan. So you've got to kind of weigh pros and cons there. Now, I want to touch on some brutal truths about ways to qualify for a VA loan real quick when you don't have income, right? The reality is that you may not be able to qualify for a loan at the time that you transition from the military. Now, while that isn't what you want to hear, it's further proof that you need to plan ahead and get your ducks in a row before exiting the military. There are several income streams that I get asked about all the time, and I do mean all the time, which simply do not count towards your income. I want to make sure I outline these right now for 2 reasons. First, because people just don't know, and I feel the need to put this information out there in order to help you and be a valid resource for you and your family and to reference. And secondly, because let's be honest, I'm really sick of having to explain this all the time. Like, I can only send the same type of text a million times, and I can only save so many text formats, and so now I can point someone to a video that'll actually answer the question better than I would be able to in a short text anyway, right? So the GI Bill, no. About sums it up. I don't care what your mama told you or what the school you go to or how much the basic allowance for housing is for the GI Bill. Your BAH from the GI Bill does not count towards your income at all. The reason's simple, right? Income is guaranteed to disappear in the near future. Why would a bank give you a 30-year loan based on income that won't even last 1/6 of that time? Because at the end of your GI Bill, no more of that income, right? So hopefully that explanation makes sense, because there's no world in which you can use the income from your GI Bill or the BH related to your GI Bill at all that it can be used to qualify for a loan. Sorry, not sorry, just the way it is. Yes, it would be nice if it could, but it can't. Sorry. So side note, in case you can't tell, this is the number one question I get about income used to qualify for the VA loan. And people genuinely try to debate me about this, about why this shouldn't be the case, as though I have some power to change the banking industry's perception of risk. Just no, you can't use your GI Bill income. Sorry. Side hustles. Side hustles are another very common income stream that people ask about. And as much as it pains me to say this, you unfortunately cannot start driving for Uber today, make $200, extrapolate that out to show that it would be $73,000 a year at that rate, and qualify for a loan. And don't get me wrong, these side hustle jobs, the income can count toward qualifying income, only if you have tax returns that back up how much you are earning this way. Many people hide their side hustle income or bounce from side hustle to side hustle to side hustle, and unfortunately, in either of these situations, you're just out of luck. Now, what you can do to take advantage of the side hustle income is utilize it aggressively to pay down your consumer debts. That's going to improve your debt to income ratio and can help your other income streams stretch a little further for qualifying for a loan. So yeah, I think that's simple, right? If you use your side hustle income to pay down your debt, then it's helping you out. If you use it to just buy new toys, you know, cool, but it's not really helping you out. You just can't find another solution. So before you get upset and you say, it's bullshit that this doesn't count, try thinking of it from a bank's point of view. Anytime a bank lends money, they're assuming a certain amount of risk. Now, it's in their best interest to assume the least amount of risk while lending money, their money, to people. For this reason, you need to be able to verify the amount of money you earn. To put this in real estate investor terms, would you buy an apartment complex if the landlord had no way of proving how much money it brought in over the last few years? Or if it made any money at all? Now, hopefully not, but the same is true for the bank. They are investing in you, and you need to be able to prove that you are a safe bet for repaying the loan. That's the way it is, and you're not going to be able to change it. Now, what is the best thing you can do to help you qualify for a VA loan when exiting the military? The best thing you can do is get a solid job and show a competitive income. Focus on finding the solution to help you be more competitive for your loan, as opposed to focusing on the downside that you can't qualify right now. Also, do not commit mortgage fraud, and don't try to lie about any of this. It just simply isn't worth it. So hopefully this tough love video helped clear some things up for you, and I look forward to hearing about your success stories on that first or next purchase.
The VA renovation home loan, and nobody knows anything about it. Trust me, it took me months to figure out what this was, or that it even existed. It was like this thing I heard about that nobody could answer any questions about. Lenders I talked to said, no, that's not a thing. And there was like this one guy who was like, yeah, I've done that. And that set me off on this like hunt, like this just legitimate manhunt to figure this thing out. One of the biggest issues with the VA loan has always been the inspection process. People say, well, it's a great idea, but you can't really use it for investing because the property has to be in perfect condition, move-in condition, can't have any issues with permitting or structure or needing repairs. Well, guess what? That's wrong now. So what if I told you that you could buy a fixer-upper without a single penny out of your pocket, right? Zero down, like the VA loan. But then you could turn around and renovate the entire property and still pay zero out of your pocket. And you could buy the property for nothing, renovate the property for free, and now you own the property with equity without paying a penny out of pocket. Sounds too good to be true, huh? Well, it's not. I have news for you. This actually exists. So here are a couple of the things that you need to know about the VA renovation home loan. It's amazing. The VA renovation loan is good for up to a 100% of loan to value purchase, up to $1.5 million. Now there is a stipulation there. The VA guarantee, or the VA guarantee plus equity / your personal investment, has to equal up to 25% of the lesser of the sales price or the after repair value. So in layman terms, that means that if you buy a property for $1 million, fix it up, and now it's worth $1.5 million, you're good. If you buy a property for $1.5 million and fix it up, you're good. So if the sales price is 1.5 or less, you're good. If the after repair value is 1.5 or less, you're good. So the VA loan does cap out, and that differs based on your area. For Hawaii, it's like $726,000 right now. Other places it's 400 and some change. But what happens is if you buy a house, say here where it's $725 and it's $1 million home,
then you have to pay 25% of the difference over the 725. So if it's $100,000 over, then I would have to pay 25% of that 100,000. So a $825,000 home, I pay $25,000 to buy it, which realistically is still nothing down. Now the cool thing is that your equity can be counted in that. So if you buy a property that's worth $900,000 and you pay $800,000 for it, now you still can get away with zero down. And that's including the after repair value. So in essence, you can get into a property for $1 million or whatever and not pay a penny into it and still not pay any repairs. Now, the cool thing is that you don't have to buy a property that expensive. In a lot of places like San Diego or whatever, you can buy a $200,000 property or $300,000 property and then fix it up for 50 to 100 grand, and now you own a $400,000 or $500,000 property with equity involved and you paid nothing out of pocket. So let's talk some of the details. Now, one of the things people always worry about is your funding fee. So it's true that you have to pay 2.15% for your first VA loan or 3.3% for any subsequent if you put zero down. If you put 5% down or 10% down, that number changes. But if you're a disabled veteran, that becomes zero. The funding fee is really not anything crazy to be worried about. It gets tacked onto the end of your loan. So you can pay the funding fee, or you can just wrap it into your loan and again, pay not a penny out of pocket. Or if you're disabled and retired, then you don't pay a funding fee at all. Now, surely there are some limits to the amount of money that you can be loaned for repairs. And the answer is yes. It has to be at least $5,000 worth of repairs, but there's no limit to the maximum amount that you can renovate. So you can buy this crappy property and put $300,000 into it, and that's fine. It just can't be $4,000. So if it's that small of a renovation, you need to like break something and spend the $5,000. I'm not recommending that, but that's just kind of funny that you would ever really need to do a $5,000 renovation. Here's where this loan gets really cool. You can even do structural repairs. This means that you can relocate load-bearing walls. You can do additions, you can add rooms, so new construction. You can even purchase a house that is completely uninhabitable at the close of escrow. That means that you could buy a tear-down house and use the renovation loan to fix it up, flip it, rebuild it, whatever, and move on with your life with equity. That is huge because the biggest complaint about the VA loan in the past has been that you have to have a perfect house to move into it, and that's simply not true anymore with this amazing VA renovation loan. All right, the repairs have to start within 30 days of closing, and they need to plan to be done by 6 months. Now, obviously, there's times where that goes over because of construction delays, but the plan has to be completed within 6 months. And finally, your contractors have to be vetted and have a VA builder ID, which is actually a good thing because that means you're not going to get some scumlord contractor. You're going to get a decent contractor, or at least a contractor that is proficient or competent enough to have gone through the VA vetting process and passed. So your odds of having a really bad contractor experience are a lot lower, which is huge because contractors is often a sore subject for people who do renovations or rebuilds. I thought about going through the entire list of repairs and renovations that this loan could cover, but it is so extensive that I did not want to do a 20-minute video. So suffice it to say this. So this is kind of mind-boggling. It'll even pay for the purchase or installation of new appliances. So you can get all your new appliances at Home Depot or whatever and wrap that into your renovation loan, and pool repairs. So if it'll cover pool repairs and your new appliances, it'll probably cover everything else. So the list is quite extensive. Do your research, but basically everything. Okay, to wrap this whole idea up, you can buy a fixer-upper for nothing out of pocket, fix it up for nothing out of pocket. You get to reap all the equity that was created in this process as your live-in flip. You move into the property, and then when you move out, you cash flow, you sell the property, whatever. This is like the missing link for investors for using the VA loan. This is huge. If you don't grasp how big this is, then you need to do a little bit more homework because it's huge. Absolutely awesome. I'm currently looking to utilize this loan right now, and it's amazing. So the reason nobody knows about this loan is that it was only pioneered about 3 years ago. It was a kind of a newer loan. Loan Depot is actually the people who I met with about this, and they kind of test piloted it. And for a little while, there were limits as far as how much you can do renovation, but that's gone. It is now full reign, past the test pilot program, and it's just out there ready to be used. Now, a lot of lenders still don't know about it or still haven't utilized it because it's kind of new territory. So for that reason, I recommend that you shop the lenders, right? So with the VA loan, there's not a whole lot of requirements. A lot of the requirements are placed by the bank. For example, I utilized a bank, or I talked to a bank about using the VA loan and they were like 40% debt to income, that's our cap. And then I talked to another bank and it's like 65%. Well, that's a huge disparity. So make sure that you shop your lenders And if they tell you they can't do the renovation loan, or if they tell you it doesn't exist, you might want to look somewhere else. The VA Interest Rate Reduction Refinance Loan, or the IRRRL, is an incredible benefit for service members that, when harnessed, can save you tens of thousands of dollars with almost no effort. Also known as the VA Streamline Refinance, the lending approval process for the VA IRRRLs is simplified so much. An IRRRL doesn't always require a VA appraisal to go through the typical VA lender underwriting process, which saves you, the homeowner, an immense amount of paperwork, fees, and time. A VA IRRRL is used to refinance your current VA loan into another. It is a tool to improve your old VA loan by lowering your interest rate, your payments, or both. Now, you can use the VA IRRRL to move from an adjustable rate loan to a fixed rate loan, which can also be extremely beneficial, especially if you got it at a low rate and you can lock that in fixed. So the IRRRL is literally a refinance option that veterans have to save themselves money, and with very little effort. Now, can you imagine calling the bank and saying, hey, I have an auto loan with you and I'm paying 10% interest. Can you just let me refinance and lower it to 4%, please? Pretty please? Cherry on top? Fat chance that you will ever convince a bank to do this. Now, you would have to go through another lender and absorb the loan, or do this or do that, and it's not impossible, but it's not the most convenient thing in the world either. However, the VA IRRRL is literally that. You can refinance to a lower interest rate through the same lender, and the process is even simpler than when you originally applied. So I love this loan, and I cannot recommend it enough, especially while interest rates are extremely low. I've seen several friends and helped several friends through my lender lower their rate, lower their payments on multiple homes, and it's simple. So look, in the mid-2020s, interest rates are low. So if you're watching this, freaking do it. Now, if you can use the IRRRL to lock in a 30-year fixed rate mortgage under 3% interest, you absolutely should. You could also lower your term from 30-year to 15-year mortgage, leave your payment the same, whatever. You can tweak the term length and other factors with your lender to ensure that you're saving the most amount of money over the course of your loan. And then you want to lock in the terms that best suit your specific situation. You don't even need a new certificate of eligibility to use this product. Now, I'm telling you, this is as simple as it comes for mortgages to save you money. The best part is you can't even use it if it's not going to save you money. So, ta-da! Too long, didn't read. Boo boo! Some of the biggest benefits for using the IRRRL over another loan are that there's limited paperwork requirements. The IRRRL rates are competitively low, and there's low or no closing costs. Any closing costs can be rolled into the loan, which means that you have no out-of-pocket expenses, or may have no out-of-pocket expenses, and you still get to enjoy your newly reduced mortgage payments. You may be able to refinance even if you don't have any equity in the home. Appraisals are not typically required. There's no credit, income, or employment verification. Yes, I said no credit or employment or income verification required at all, which is awesome. So, how long after purchasing a home can you use the IRRRL? All right, so it requires a seasoning period of 210 days from the date of the first payment, or 6 monthly payment, the 6th monthly payment, whichever is longer, before an existing VA loan becomes eligible for the IRRRL. Now, I know that sounds like a bummer, but why can't I use it sooner? I got it, but this law came around due to the fact that there were predatory lenders soliciting veterans to refinance their home loans all the time, right? Some lenders were so happy to execute IRRRLs because of their simple nature that they would talk to previous clients about refinancing frequently, like 2 months, hey, you should do this, hey, you should do this, which opened the door to what they call churning, where lenders essentially convince borrowers to refinance so that they can earn a commission or origination fee, and they just kind of keep pushing that 30-year rate out, knowing that they're making money and the veteran thinks he's... Anyway, not a good deal, right? So the 210 days is to save you. What are some of the qualification requirements? Now, this is actually pretty decent. So obviously there are some requirements in order for you to qualify for the IRRRL. You can't just take out a loan, not make any payments, be a turd in general, and then qualify for a loan. That's not how it works. You need to be current on your payments with no more than 1 late payment in the last year. That's a 30-day late payment. Your new rate or the monthly payment must be lower than the previous loans unless you refinance from an adjustable rate mortgage to a fixed rate mortgage, which is also still beneficial. So it has to be beneficial for you to use it. You must certify that you currently or previously occupied the property, so you have to have lived in it. You must have previously used your VA loan eligibility on the property you want to intend. So you can't VA IRRRL into a home that you didn't use the VA loan. You must not receive any cash from the VA IRRRL process. You can't cash anything out. And if you have a second mortgage on the property, then they need to agree to remain in second position after the IRRRL goes through. So all in all, the qualifications for executing the streamlined refinance, it's set low, like it's a low bar. Basically, if you made your payments and you abided by the VA loan guidelines for the original loan, then you should be able to use this benefit, right? And you can even use this on an investment property. Yes, you saw that and heard that correctly. You can use the IRRRL to lower the cost of your mortgage on a rental property that you no longer live in, which is incredible. That's just an incredible benefit, because most of the time an investment property costs way more than a primary home, right? So this is an incredible benefit, especially to those of us in the military millionaire community with multiple VA loans on properties that we no longer live in. So you can just, which executing a VA streamlined refinance is simple, and it can make your rental property cash flow more each month. So cha-ching, why buy another house when you could just save $300 on refinancing and then buy another house? And there's no income requirement. I know I said this before, but the IRRRL does not require income or credit verification. The Department of Veteran Affairs assumes, I think this is awesome, that since you qualified for the original loan and you have not missed payments, then you should absolutely be able to qualify for a more affordable loan, right? It makes sense. And I love this common sense approach. It's not something you find every day in the military, so it's a breath of fresh air. The biggest benefit to not requiring an income verification is that a veteran who has exited the military, maybe they're now a college student or whatever, and they have a lower income now than they did when they were in the military, can still take advantage of the IRRRL, which is extremely powerful when you consider that your average college student wouldn't qualify for any mortgage, let alone if it was like a San Diego home and now you're living below your means in Missouri or whatever, because of their low debt to income ratio. So this is awesome. Now there's an energy improvement mortgage, which you can actually use. So you can use the energy improvement mortgage in conjunction with the VA IRRRL so that you can add the cost of some energy efficient upgrades to your home. So this is the only way you can kind of pull cash out, is if you add a little cash to the loan to pay for energy improvements. Not all upgrades qualify for this, but this is a great way to reduce your mortgage payment and potentially lower your energy footprint or utilities bill all at the same time. Now, as with everything in life, the VA IRRRL is just not perfect, right? So there are always a few downsides to loan products, but in my opinion, these are somewhat minimal compared to the vast upside and benefit of using this streamlined refinance. The first one we already touched on is you can't cash out. So unfortunately, you cannot use the VA IRRRL to take any cash out of your property. Now, while that's a downside, there are other options to cash out refinance your VA loan, just not with this particular product. The dreaded funding fee. Here we go again. You will have to pay a funding fee with the IRRRL. Now, provided you don't meet the service-connected disability waiver or other waivers for this fee. And, that's a bummer, but the funding fee for IRRRLs is only 0.5%, and it's wrapped into the mortgage balance. So for every $100,000 you owe on the home, your funding fee will be a measly $500. And to put that in perspective, if you took a loan out at 4% interest over a 30-year mortgage, $500 equates to like an additional $2 a month on your mortgage payment. So given the awesome benefits offered by this loan product, I'm sure you can spare the extra $2 a month for every $100,000 you buy. So on a $1 million note or mortgage, you would have to pay $20 a month. And I guarantee you, by using this process right now, you would save more than $20 a month. So not really that bad. Now I'm going to touch on the direct mail bait and switch, which is less of a downside of the actual mortgage and more of a downside of just crappy, borderline predatory lenders. Because the VA IRRRL is such a simple process for you and the lender, there are people who will try to get you to refinance frequently in order to benefit from the loan. Or they'll send you unsolicited whatever, and they'll tell you about all these great rates that you can get, but if it sounds too good to be true, it just might be, right? So when you receive these direct mailings, letters, postcards, whatever, that have extremely low interest rates advertised, or when someone in my Facebook group decides to tell you, oh, I can get you 2%, like, no. There's a good chance that the numbers really are just too good to be true, like they sound. Lenders know that if they allure to an incredible rate to get you into their pipeline, you will most likely stay, even if you ultimately get quoted a higher rate. Think about it. If you've gone through a whole mess of paperwork over the last 2 weeks, are you really going to want to drop everything with that lender and go work with somebody else? Maybe, but not as fast as you would at the beginning of the process before you were in the pipeline. So if they just advertised a mediocre rate up front. So you want to look at the annual percentage rate as opposed to just the interest rate, because the APR would be higher if they were using discount points. Also, look at, look at the fine print. Like maybe that interest rate is if they were doing like a 10-year mortgage, right? You need a 30-year. Like, you got to look at those kinds of things. So the Consumer Financial Protection Bureau, or CFPB, they gave a warno, right? So consumerfinance.gov, and there's a link I'll put down below, but they give some great advice for navigating these offers. Many of these solicitations appear too good to be true, and sorry. So if there's extremely low interest rates, or if they're advertising thousands of dollars in cash back, which is false, if they say you can skip mortgage payments to save on paying for 1 to 3 months, if there's like no out-of-pocket expenses advertised, no waiting period, don't fall prey to these unsolicited offers. Here's some advice to keep yourself safe. Again, this is from the Consumer Financial Protection Bureau, and they note several red flags that you can look for if you receive such offers. Low rates without unspecific terms. So if an advertised rate does not explicitly state that's for a 30-year fixed rate mortgage, you might respond only to find out that the actual rate is for like a 10-year loan or an adjustable rate loan or whatever, and that it assumes that you'll buy discount points or whatever, right? So they're just trying to get you into their funnel. And then they might say saving by skipping payments. So the VA bars lenders from claiming borrowers can use the IRRRL to free up cash because it will give them the option to skip 1 or 2 payments. It's just bad business practice anyway. Escrow refunds. If the CFPB they've received complaints from service members who were told that they would receive a substantial refund from an escrow account, but then they got a lot less after closing. So just keep tabs on that as well. Aggressive sales tactics, as with everything I'm always saying, if it feels like slimy or spammy, some lenders may try to push you into a VA mortgage refinance, and it isn't because it's in your best interest, right? If they're being pushy, it's probably not in your best interest. They're probably worried about their commission. Now, even with a law against predatory VA lending, it's important to understand any loan offer you receive and never rush to make a decision. No matter how great the deal seems, if it looks too good to be true, it probably is. So, should you use the VA IRRRL? Ultimately, the answer to this question is the same as any other financial question. It depends. But with that being said, the VA Streamline Refinance is a great product that could absolutely save you tens of thousands of dollars over the course of your loan. If you can lower your interest rate, your payment, your loan term, or maybe just switch from an adjustable rate to a fixed rate mortgage, then I just say go for it. Like, it's gonna save you money. Why not? So just be sure that you use a solid lender that has your best interest at heart, and always review the terms thoroughly to ensure that you are getting a deal that is every bit as good as you believe it is. Don't get burnt. Do your homework. What is a mortgage assumption? So assuming a loan, this is actually really cool because this is creative financing, right? Like, people don't think about it this way, but this is creative financing. So let's say I bought a house 2 years ago, use a VA loan, 2.5% interest or whatever, we'll say 3% interest. And now I'm moving across country, and that loan was, we'll just say it was a $200,000 mortgage. And I still owe, I don't know, $190,000 on it. And I'm now moving, and my house is worth $250,000. And I want to sell my house for $250,000. But interest rates are now like 8%. And so I could sell it for $250,000 and normal interest rates, whatever. And that's fine. People can buy it. That's great. And that might just happen. But if a buyer came to me and said, hey, I would love if I could take over your $190,000 mortgage that is a 3% interest rate that you're already 2 years into, so I'd only have 28 years left on the amortization cycle. Can I do that? And I'll pay you $60,000 down. That's a mortgage assumption. As long as the mortgage company approves it, which with the VA loan, as long as the VA approves it, right, as long as you meet the criteria, which we'll get into, generally they're going to, then that's a win-win, right? I as the buyer, or he as the buyer, or they as the buyer, or them, or he, or they, or she, or whatever pronoun, whatever, however, that person is going to assume that loan 28 years into or 2 years into a 30-year amortization cycle of $190,000 remaining on an original $200,000 note at that fixed 3% rate, and then they have put $60,000 into, the purchase, right? Now you got to bring cash to close on that case. It's not going to be zero down with the VA. We'll get into some creative stuff later. There are ways to do that. But that's the basis of a mortgage assumption. You're taking over the existing mortgage at the existing rate to avoid that higher interest rate that we're currently seeing. You got to bring some cash to make it work, but that rate is very valuable. Win-win. Cool. So VA loans, yeah, they're assumable.
Cool. Criteria. This is the first piece of the puzzle here. So in order for a VA, this is from the seller's side. So in order for the VA to even think about approving your mortgage being assumed by a buyer as the seller, the existing loan must be current. So, or if there was a past due amount, it must be paid in full before the closing. So you cannot use the proceeds of the closing to make the loan current. You have to make it current before the closing of the property. The buyer, assuming all mortgage obligations, including repaying the VA if they default on the loans, the buyer has to be okay with that. The original owner or new owner must pay a funding fee. So the new funding fee is 0.5%, which is actually way less than like a funding fee on any other mortgage, let alone, or origination fee on any other mortgage, let alone the VA. So like people are like, oh yeah, but you got to remember the funding fee. Look, if you get a mortgage of any type, of any product, for any loan to purchase any property ever, whether it's an investment loan or a conventional loan, FHA, USDA, doctor loan, VA loan, I mean, I do not care. Unless you are a VA loan with a Purple Heart or 10% disability where it's waived, with the exception of that criteria, there's not a loan out there that I know of where the origination fee or funding fee or whatever else they want to call it is less than 0.5%. So I don't want to hear it. Buyer must qualify for the existing mortgage based on credit and income guidelines, which we'll get into. And a processing fee must be paid in advance for the cost of pulling the buyer's credit fee. So basically like, you know, the $25-50 to apply for the mortgage, like process, like check your credit, whatever. Normal stuff, right? Nothing crazy. So who can assume the VA loan? Realistically, anybody, as long as you meet the criteria. So a veteran or a service member can assume it, but also a civilian can assume it, right? So that's a common misconception, and I was going to dig into it later, but I'll just talk about it right now. So if somebody who is eligible for the VA loan, has remaining entitlement, assumes let's say I'm the seller. If I'm selling my home and a service member or veteran assumes my loan, then their entitlement can and will replace my entitlement. Now there's a document you have to make sure you hang on. When a VA loan is assumed by another eligible veteran, entitlement typically does not need to be transferred and can simply be exchanged between the buyer and seller. Substitution of entitlement. So you just have to file a substitution of entitlement with the VA. As long as you do that, boom, I'm like, high five, you get my mortgage, substitution of entitlements filed, so you're taking my entitlement. Now I can go use a VA loan with that same entitlement elsewhere. Now, if you sell or let a civilian or somebody who did not have entitlement, so if it's a service member who doesn't have remaining entitlement and you let them take over, or a civilian or somebody who does not rate certificate of eligibility, like does not have entitlement for the VA loan, takes over your mortgage on the VA loan. At that point, or if you fail to get the substitution of entitlement, at that point, you as the seller do not regain your entitlement until that mortgage is paid to zero, whether that's through a refi or a sale of the house where they pay off the mortgage. Which means that if you were selling the house to move across country and use the VA loan again, you may not be able to, or at least you may have to pay 25% down. Or, you know, if you're selling a $300,000 house, you're moving to another market that's $300,000, you might still be able to, right? But if you're selling a $800,000 house, well, sorry, your entitlement's tapped. And if you don't get it back by selling to somebody who's qualified and substituting the entitlement, you're screwed, right? So you need to be aware of that. You can sell to somebody who's not eligible, so don't buy into the lie that you can't. It can go. This is what's cool. The VA loan can be assumed by somebody who's not eligible for the VA loan. You will lose entitlement. So you need to be aware of that. That's not necessarily a bad thing. Like if you weren't planning on using the VA loan again right away, you might be fine with that. All right, let's talk through the how real quick. How does this work? How do you find one of these things? Cool. A couple of tips for how you might find some of these. And this is kind of a new thing, right? So I got to talk to a buddy. So I got a buddy who runs Military by Owner. And we're going to talk through like some ways to maybe see if we can find out. We talked about it briefly, but we're going to see if we can figure out how to find some of these. There's got to be a way to like actually make it easy to be like, I'd like to buy a VA loan assumption. Like there's got to be a way to, I'll tell you right now, if you're not in my Facebook group, you should be. People are throwing them up all over the place right now. Hey, I'm thinking about moving. If you're interested in buying a in this area, I would be willing to let you assume my mortgage. Here's the property. Hit me up. Like that's happened probably 5 times this week alone. I've seen 2 or 3 in Virginia.
and yes, you know, you gotta have the money for the down, like, or there's other options, but like realistically, people are open to it. They're posting it even just in my Facebook group. So it is becoming more common. Like, I've never seen that up until probably 6 months ago. But now in the last month, it's like more, it's picking up, right? Because people are PCSing and they've got great loans and they're willing to say, hey, you want my loan? Like, rather than selling the house to somebody who's gonna get stuck with a high interest rate, like, you know, just take over my loan, give me cash, and we'll move on. So it's cool. So, okay, so a real estate agent can help you out, right? Great. As always, if you'd like an introduction to a really solid real estate agent in your area, hit me up or click on my website and this button says recommended agents. We've got a solid list. Also, if you're thinking about becoming a real estate agent, we are building a team to help service members and vets become agents. So you can join my team. Multiple listing service, the MLS, you know, easy. You can actually, I bet you what's going to happen now is you can probably go in there and search assumable, that word, or assumption, either of those words, and I bet you'll be able to find these mortgages. Print ads, that's a bit archaic, but you know, maybe they'll be in your newspaper. I don't know. Specialized websites, so like takelist.com or Zumption.com. They're, you know, willing to undergo assumption process. So take a look at those. I didn't play around with them too much, but and then like I said, I'm looking to I'm talking with my buddy. We're gonna see if we can figure this out with you know, maybe military by owner or whatever. But jump on my Facebook group. They're popping up all over the place there. So, you know, post where you're at, and if you're looking to move and buy somewhere, like, hey, I'm looking to move here. Anybody looking to sell a house that would be willing to assume, you know, have their mortgage assumed? Whatever. All right, so how to take advantage. So here are the requirements to assume a loan, right? Okay, so the purchase must be, you have to intend to occupy as your primary residence. We already talked about that. Must be purchased, minimum credit score. There's not a minimum requirement, but most lenders want to see a 620 if they're going to let you assume. Now I've seen as low as like 560, 580, but you know, that's kind of the norm with the assumptions is like 680. They want to see a little bit higher, I think, for the assumptions. You've got to have a back end debt to income ratio of 45% or better. So basically, you've got to make enough money for the debt to income to actually support the loan amount. Funding fee 0.5%. And you got to make a down payment that's equal to the difference. So if it's a $190,000 remaining mortgage, $250,000 purchase price, you've got to fork the $60,000 difference, right? Somehow, some way. There are other ways to do it. We'll get there. Okay, exception. So here are the exceptions to VA approval. So if the VAs, these are like, so according to the VA guidelines, these situations do not require the VA approval in order to execute. So if the borrower's death and the loan was assumed by a relative, transfer occurred due to legal separation or divorce, assumption not require transfer of rights because the owner remained in the beneficiary, assumption occurred as a result of spouse or child becoming a joint owner, it required the creation of subordinate to the lender's security instrument, not include the transfer of occupancy rights, security interest in the household appliances for purchase money was created in the assumption. Okay, so let's see, one other thing. Okay, so yeah, talked about funding fee, cash to close, financing stuff. We're gonna get to good stuff in a minute. Am I missing anything in here so far? Okay, no. So I'm gonna just read a quick little bit of bullet point here, and then I'm gonna talk to you straight up about why this is important. So the math here is, let's say, for ease of math, I compared a $500,000 note, right? So a $500,000 mortgage at 3%, 6%, and 8%. So at 3%, which is, you know, 2 years ago, a $500,000 mortgage was $2,108 a month. At 6% interest, which was like 4 months ago, that was $2,998. And at 8% interest, which was when I wrote this, but I don't think it is anymore, was $3,669 a month. So, you know, the difference between a 3% and an 8% rate is significant. Right? That's huge. And then the other thing too is like with the amortization cycle, right? So, I mean, I did a ton of math, so I'm not going to bore you by reading through that whole thing. If you want to see all the math and you want to see how it all breaks out with like picking it up like year 2 or 2 years into the amortization cycle and how much more of your payment goes to principal rather than interest, it's actually really interesting because of how amortization cycles work. So I kind of did some of that math out. So go check out the blog post if you want to go way more into detail on all this and see like how much more it's super cool because like 2 years into an amortization cycle, you know, it depends on your interest rate and your purchase price and all that. But let's say it was a $500,000 house and you had a really low interest rate. Like 2 years into the amortization cycle, each time you make that monthly payment, you're probably paying $200 or $300 or $400 more towards principal than when you originally started paying the loan. So that means that if you take over 2 years in, the original guy, or girl, whatever, their first 2 years of payments weren't as effective towards paying down the note as where you're starting. It's like if you imagine like you're pushing a flywheel, and you start pushing and it barely moves. And you start pushing and it barely moves. And then as you're trying to push this thing, it slowly starts to spin, and as it spins, it slowly starts to spin faster, and as it gains momentum, it becomes easier to spin, and then like you finally get it to start moving, and then you're like, fuck, I'm tired, and you just hand it to someone else. And then now the new guy, you come in and you're like, wow, it's moving, this isn't so bad. Now you get to push it all the way through to when it's moving on its own, and then you're like, just push this all through to the end. Like, that's kind of what this amortization cycle is like. It's like someone got this freaking thing to start moving, and all you got to do is take it to the finish line. Pretty sweet. So that's huge. Okay, so why does it matter in 2023? Dude, rates suck, and if you can jump in on an incredible rate as the market kind of like maybe dips back down a little bit, maybe not, you jump in on this incredible rate. Here's the kicker. Some of the stuff that you can probably mess with here is like, so that additional, let's say you got to come out of pocket $100,000, like you're buying a $600,000 house, there's a $500,000 note. You can ask the seller to carry the difference. There's nothing that says you can't come in and say, hey, I'd like to assume your $500,000 VA loan. That's at 2.5%. However, I don't have the $100,000 down, so I'm gonna live in the house. I would like to pay you 5% interest on the $100,000 as a seller finance, amortized at whatever percent, right? And maybe because of the way that everything works out, you can even be like, look, I'll pay it back over 60 months, like major payments on that. You just suck it up. I don't know. However it works, right? Or 30-year amortization, but I'll balloon payment it out in 5 years or 10 years. However that works for you. Or maybe you can find someone who does a second position. Or, or you have the cash and you pay it. That stinks, but it's not any different than if you put 20% down on a conventional loan, except you locked in a 2.5% rate instead of the 7, 8, 9% you'd be paying right now. But I think there's actually going to be a point where if prices drop, you're going to be able to buy like almost at loan balance with that great rate. So 2023 is going to be an interesting year. VA loan assumptions are going to be sweet. So definitely keep your eye out on them. Sellers can carry a second. There's definitely some creative ways to play around with this. We already talked about affecting entitlement. Let me just run through my pros and cons list real quick, and then I'll touch through the last couple bullet points, and I'll let you get on your merry way. Okay, pros of assuming a VA loan. This just kind of wraps it all up. So a potential buyer isn't required to be eligible for the VA loan. Awesome. Funding fee and closing costs are reduced. Awesome. Possibility to take over a lower interest rate. Yep, but it's definitely lower than current economy. Whatever veteran assumes the mortgage sellers will be able to regain their full entitlement. Cons: seller's credit score could be negatively affected. So if the buyer defaults on the loan or makes a late payment before the liability is transferred. So, the lender will hold the initial borrower responsible for the payment until there's a release of liability, which could take some time depending on the lender. So you just need to make sure that you push for that release of liability to get done quickly. So that is one downside. If the release of liability is not done and the new borrower defaults or makes late payments, it could tap your credit. But you can get that, resolved down the line, and ultimately it shouldn't take that long to get the release of liability done. So I'm sure there's actually ways to get around that with an attorney or whatever to, cover your ass. Seller may have to forfeit their entitlement if the buyer is not eligible. Seller will remain liable for the loan until they relieve. We already touched on that. Release of liability. Buyer may have to make a down payment. Yep, covered that. Lenders are not required to approve the assumption. Most will, as long as you're qualified. And depending on your lender, it can be a lengthier process, right? So, if you're talking to big box lenders, it might suck. But So here's some frequently asked questions. So how much of a down payment is required? We already talked about that. Can they carry a second position? Yes. So as far as other loans that are assumable, the FHA loan, also assumable, pretty similar to the VA loan. FHA, VA loan, fairly similar, both generally assumable, both blah, 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 blah. The USDA loan, also assumable, but the majority of them, from what I understand, the rate and terms will actually change. So it's almost like you're assuming the remaining note, but you're gonna get new rates and terms. So it's like a new mortgage, but with the doesn't seem like an actual assumption. Sometimes it'll stay with the same rate and terms. Doesn't seem super advantageous. Conventional seems like it's really rare because of the due on sale clause. It seems like they don't really like you to actually do assumptions. Looks like I covered it all. Right, so bottom line is this. VA loan's assumable. VA loan is still, in my opinion, the single best loan product on the market. If an agent or lender, as always, I'm telling you, if an agent or lender is telling you that the VA loan is not competitive, it's because they're not an expert, right? It's not their fault. I'm licensed as an agent. I'm licensed as a lender. I don't actively do either. I just got licensed because I do referrals, right? I recommend people and I get a small cut of their commission for making introductions because I have a big network of vetted people that I know and trust and whatever, and I make connections because I'm a connector. That's what I do. And so I don't actively do the piece, but that means I work with a ton of people, and I'm basically like an unbiased third party because I get to basically my entire revenue source is based on how well these other agents and lenders actually transact, right? It's not based on a bias of how good I am. And so I see a lot of this and I hear a lot of this, like my agent said this and my lender said this. And the reality is, like, I can tell you from being licensed in both, they teach you what the VA loan is and they teach you what the FHA loan is. But the information they give you about the VA loan is like zero down, entitlement, who's eligible. It's the basics. They don't teach you anything about the nuances. So being licensed does not mean that you know jack shit about how to actually use the VA loan, right? And being licensed and a veteran also doesn't mean that you know jack shit about using the VA loan, right? So just keep that in mind. There are tons of really solid agents out there and lenders who are veterans, not dogging on that. I'm just saying you really need to know that the person you're working with actually did a deep dive in the guidelines. And if they are not willing to pick up the phone when you write an offer, call the listing agent and sell the VA loan and sell you as a buyer to that listing agent, you've got the wrong person. And if they're going to tell you that your offer is less competitive and your VA loan is less competitive for XYZ reason, you've got the wrong professional in your corner. And I'm sorry. I'd be happy to help you out, not trying to steal you away from professionals, but I just hate to see veterans getting screwed like that, because we have helped people, all 50 states, in the hottest market that this nation's seen in God knows how long, buy over $50 million worth of real estate in the last 2 years with no freaking issue, including like $1.93 million duplex in fucking Venice Beach, California in 2021, in the freaking height of the craziness, zero down. Got a guy right now who's about to buy a $2.6 million house in Dallas area, zero down. Like, the VA loan's competitive. Like, there's some crazy stories out there that I could tell you. So don't mean to ramble. I just figure if you're gonna watch this VA assumption video all the way through, like, this is a good point to throw in here and just say, look, make sure you're covering your ass, make sure you're taking care of, make sure you're working with the right people.
The crap that gets thrown around about VA loans, and some lenders that just don't say things that are very legit, and there's bad info. So we just kind of wanted to touch on a few of the topics that are common right now. The first thing is, and we see this all the time right now, I got locked in at 2.75, but someone said that I should go for 2.25. What do you think? And so my thought, long and short, is look at the history. Loans have been as high as 16, 17%, and now they're as low as 2.75. Do you want to bet that you're going to beat the historical low and go down to 1% or whatever? Or do you want to just realize that 2.75 is fucking awesome and the odds are it's going to swing farther the other way? So anyway,
And I've got two things on that. So one of the biggest things is take a look at who's telling you that they can get you down to a 2.25 or a 2.5. And then think about this. You're in escrow, you're already under contract, and we've seen this a lot where people are already locked in. They're 15 days into a 30-day escrow. Do you really want to lose the deal over 0.25%, 0.5% rate, when in reality, let's say that rates do go lower, which they may or they may not. No one really knows, but you still have the interest rate reduction loan.
Yeah.
Now, do you want to roll the dice and see if this lender who's just quoting you without seeing any of your financials is able to get you down to this 2.5, 2.25 and see if he's going to close your deal on time, or see if he's even going to be able to close your deal at all? If that's something that you're willing to risk, then go for it, but I personally wouldn't do it.
Yeah, and he brushed over it, but I want to touch real quick that if a lender gives you a quote, like tells you I can get you this rate, and you haven't given them all your financials yet, and they haven't pulled your credit yet, like, I mean, realistically, that's illegal because they don't know your situation. They're just what they're doing is they're promising you something, and then they're getting you into the funnel, and then by the time you're 10 days into this thing, they say, oh man, I know we said 2.25, but I can get you 2.8. Like, the odds are you're probably going to stay with them instead of going and shopping around because you've already done all this crap and you're already into a contract. So one of the first things I ask a lender when I look at talking to them is, hey, what rate can I get? And because I want to know, like, if they tell me, oh, I can get you this rate without knowing anything about me, then they're probably not someone I want to work with. Now if they give you like yeah, I'm seeing kind of this is like the trend, or this is the prime rate right now, or is it prime, par, whatever, I don't know, random lender terms, but if they tell you like this is kind of the average, or this is kind of what we're seeing, like, okay, got it. But if they give you a quote.
And here's a big thing too, is I get asked, what's the VA interest rate today, or what's the conventional interest rate today? And the thing I have to explain is the interest rate really depends on the strength of the borrower. So, and there's so many other things that go into it, such as if you're doing conventional and you're buying a condo versus single family, there's going to be a rate adjustment. You can go look, if you're really interested, at all of the loan level price adjustments for each loan product, and you can see what will affect your rate and what won't. What credit score you need to be at this rate, 30-year versus 15-year, 10 and 20. Those are all things that your lender has to actually know before he's able to give you an actual rate and an actual quote. And then on top of that, nothing really matters until you have a signed purchase and sale agreement. Once you have a signed purchase and sale agreement, then you can start looking at rate. But what a lot of people do, and I work with a lot of people that have previously worked at call centers such as Loan Depot or a few others that I won't mention, but they're trained. They get that. That's the first question they get. What are your interest rates? They're trained to just throw out a number. So throw out a number that will keep someone interested, get someone to get their credit in, and then whatever, by the time they actually get down to giving the actual rate, they can just say that the rates changed due to that day. They can say a variety of different things, but the fact of the matter is you're probably already too late. So just something to take in consideration. If you are going to look, make sure you have a purchase and sale agreement and the lender's quoting you based off of your finances and your scenario, not just the VA interest rate. If you have someone that says the VA interest rate is this today, he probably doesn't know what he's talking about.
All right, so what about points? Tell us a little bit about, people don't seem to understand how points work with loans.
So points, you'll hear them referred to as discount points. And for some reason, a lot of people right now are hearing you don't want to pay points. There's never pay any points. The points are bad. And the reality is, it really depends on your situation. So let's say that you're doing a VA purchase and you're already down to a 2.875. And in order to get down to a 2.75 based off your scenario, you have to pay 40 basis points. So basically 40% of a percent. And that equals out to $1,000. Let's just throw some random numbers out there. Well, we're gonna look at how long do you plan on keeping the property? Do you plan on keeping the property for 6 months? Which you shouldn't if it's a VA loan, but if it's a year or 2 years or 5 years, we're gonna look at that. So if you say, I'm only being stationed here for 3 years and then I'm gonna sell it, then we'll look at that. Okay, how long will it take to recoup those discount points to where after they cover themselves, everything else is pure savings. And it may make sense, it may not. I personally paid $13,000 to $14,000 in points because interest rates a year ago were in the 4s, and it made sense to me. Now, no one was planning this huge interest rate drop. No one can predict what rates are actually going to do. So I didn't take into consideration the interest rate reduction loan. And, you know, did it make sense? If I would have done the interest rate reduction loan, probably would have made more sense to do that anyway. Yeah. But as far as paying discount points, it's not always a terrible idea. It just depends on your situation. And one thing to take into consideration is there is that interest rate reduction loan. So if you are worried about rates going lower in the next 7 to 12 months, that's always available. You just have to wait 210 days in order to do that interest rate reduction loan.
Cool. And yeah, I got nothing to add there. Awesome. Processes, systems, and closing times. How does that matter and why?
Okay, so let's say you're in a market like this current market, which everyone's seeing. If you look at San Diego, Fresno, you know, the Bay Area, Denver, all places that I'm actively seeing 10, 12, 14 offers in one day. Now, what matters to these sellers? They want to know that you're a strong buyer, that you're going to close, and that it's going to be done quickly. Because you got to think, they're taking their house off the market. They're not accepting any more offers. They want to go with someone that's going to close. They don't want to take it off the market just to go through the inspection period and fall out of escrow. That's not something that they want to do. So what they want is short contingency periods. So when you're picking a lender, yes, obviously pick a lender with a good rate. But if you're picking a lender that's doing a 60-day close and a 15, 20, 30-day loan contingency, it's probably going to be pretty hard to get an accepted offer in a competitive market. Now, if you're in a market like, let's say, New Orleans and Louisiana, and you're not seeing that, maybe it's less important. But right now, what we're seeing is multiple offers in the same day, and they're competitive offers. You're going to have 15-day conventional closes. You're going to have cash offers. In order to compete with a VA loan, which they can be very competitive, it's something that a lot of people don't understand, is active duty military, your pay's not going anywhere. If you can just get short contingency dates and you can tell those sellers, hey, in 10 days from now, you will know that the only way we're falling out of escrow is if it's something due to the house. Yeah. We have loan approval in 10 days. You're going to be competitive. You're going to be able to offer a lower purchase price or get in the home that you actually want to get into. So just something to take in consideration with contingency dates. And when you're picking a lender, pick someone that's actually competitive and not someone that just can say that they can get you a good rate.
Yeah, and so a lot of times what we hear is from realtors or in competitive markets is that the VA loan is not competitive. People, they get a bad rap for whether it's because something came up in the inspection or the lender couldn't close or whatever. And that's, I don't know what the right way to say this is. So we didn't talk about this before because I don't know what he's allowed to say and not allowed to say because he's actually got a license and I'm just a schmuck. But in my unprofessional opinion, not fact, but opinion, lenders that market strictly to veterans seem to fucking suck. So Veterans United, garbage. They own the market for VA loans, but they added fees, extra closing costs, long closing times. Navy Federal, love them to death. They're my business bank. They're great. Not good with closing VA loans. USAA, same thing. There's some others. There's even a veteran communities that, you know, with real estate. Like there's a couple different lenders out there that they cater to military, and I don't know if that's a correlation or a causation, but they don't seem to do very good. So I like I don't know, like his branch does everything. Like he specializes in VA loans, but they close everything. So I don't know if there's anything to that, or if that's just me feeling, or if you're even allowed to talk about that, but that's what I've noticed.
I mean, so I won't say anything negative about any other companies, but one thing I will say is probably one of the best lenders that I know in California, and I think you know who I'm talking to too. Yeah, he's not a veteran. And there's a lot of lenders that aren't veterans that crush it with VA loans. Scott Evans is a huge one. You'll see him all over if you're stationed around Camp Pendleton. nothing but great things you hear about him, and I don't know if he's a veteran or not, but it doesn't matter. So just because someone's not a veteran, or just because someone is a veteran, doesn't necessarily mean that they're not a good VA lender. They're gonna learn the lingo. They're gonna know what BAH is. They're gonna know what PCSing is, because they've been working with veterans for years.
Yeah.
So just because someone's not a veteran doesn't mean that they're not gonna be a good VA lender, and especially vice versa. Just because someone's a veteran doesn't mean they're gonna be a good VA lender, doesn't mean that they're gonna be the best realtor that works with VA loans. It doesn't mean that. So find someone that's good based off of their actual business, not just because they were in the Navy for 4 years, or they were
in the Marine Corps for 25 years and they've been a lender for 2 years, but they're a veteran and the other guy's been a lender for 20 years. Who do you think you should work with? A new guy? You know, I don't know. Like, take a lot of things into consideration. It doesn't, the title veteran doesn't automatically mean someone's good at their job. Unfortunately, hate to say that, but
very true.
True.
Here's some of the biggest advantages for the VA loan, right? It is zero down, everybody knows that, right? And you can even get up to 4% of the closing costs or the purchase price, 4% of the purchase price covered towards closing costs via seller credit. So that's not a guarantee, but you can negotiate it depending on how hot the market is and how hot the house is that you're trying to buy. It is very possible. Now, then 75% gross rental income. So if there's a triplex or a fourplex and 3 of the units are rented out for $1,000 a month, $3,000, then you can do 75% of that, or $2,250 a month would count towards your debt to income. Now, the lender may require 2 years experience. That's a lender overlay, not a VA guideline. The VA guideline specifically says veteran must have a likelihood to succeed as a landlord. Now, if the lender tells you that, then the runaround is to just say, well, what if I hire a property manager? And if they still aren't going to work with you, then, you know, I'll introduce you to a lender who will. It's very doable, right? That's a very common practice. Now, you must be occupying a house hack that you can occupy one of the units in. So that unit has to either be month to month or vacant already. So if it's month to month, you can tell them to leave, and then you are going to need up to 6 months cash reserves if you go off the 75 gross rental income in order to qualify for that home. Now, there's no PMI, there's no mortgage insurance, there's no private mortgage insurance. All that stuff is way more expensive. There is a funding fee unless you have a Purple Heart or you have a 10% disability rating. If you don't meet either of those requirements, there is a funding fee, but it is, nothing compared to the cost of PMI and MIP. It comes out to like $11 a month for every $100,000 you borrow, and PMI would be like closer to $100 a month. So yeah, definitely still a savings there. Okay, the restoration of entitlement confuses a lot of people. So bottom line is, if you sell everything, you can restore your entitlement. If you refinance the loans, or you still own a home or whatever, and you want to restore your current entitlement so that you can go above your county loan limit, then you have to do a one-time restoration. You can only do it once. You can't refinance into another property, restore entitlement, refinance to another property. After that one time, you have to sell everything. Level playing field to do it again. Tenants are great around military. There are always problems, but generally speaking, service members are better than non when it comes to tenants. No limit on the debt to income ratio for the VA loan. What does that mean for you? That means you can qualify for a higher purchase price off of your income than you would be able to on other mortgage products. Yeah, active duty means you're buying your military bases. Now, the credit scores with the VA loan, they don't adjust as frequently on your rate, and so you'll get a better price with the VA loan all the way down to 641. You'll get the same interest as if you have an 800. Vice on other loans that'll adjust at 740, 680, and then 640. Also, the VA loan is a half a point cheaper on average on multifamily, which is great for this house hacking conversation, right? So credit and interest rates are definitely better situations with the VA loan. Okay, it can be used more than once. We can cover that. We can beat that horse all day, but ultimately it can be used an infinite amount of times if you are, restoring entitlement by selling properties. Otherwise, you've got that one-time restoration. But you can, if you buy $200,000 houses in an area that it costs $800,000 as a county loan limit, you can get 4 loans for that price. So you can still have multiple out without having to do anything with your entitlement. I already covered the hint to your interest rate for multifamily. We'll break the numbers down there for a minute. The renovation loan, you can do a zero down renovation loan. You can also do a zero down construction loan, which is like called a one-time close, where you can buy and build with the VA loan. They are programs that exist. A lot of lenders won't do them, and unfortunately they will tell you it doesn't exist rather than telling you other people do it. So, you know, if you need an intro to a lender, let me know. The IRRRL, I'll link to this resource as well, but the interest rate reduction refinance loan is phenomenal for when rates drop. You can just refinance. You don't have to have income anymore or credit score verification or anything. You don't even have to live in the property anymore. You can just utilize the VA IRRRL and drop the interest rate, which is a great hedge when interest rates are going up like they did in this year, last year, 2023. So this is just to show you what your income being $7,200 a month, and that's just a number we came up with. I know that's not everybody's income, but we're just saying, hey, $7,200 a month income. This was examples I got from one of my lenders. For a single family house, you would only qualify for up to $4,600 a month in principal, interest, taxes, and insurance, which is roughly a $600,000 square single family house. In case you haven't guessed, this lender's in San Diego. For a duplex, if you brought in $7,200 and you assume $2,600 market rents, which means $1,950 would go towards your debt to income after the 25% deduction, so 75% of gross monthly rents, then that means you could qualify for up to $5,223 principal, interest, taxes, and insurance, which would qualify for you for an $800,000 duplex. Triplex, assuming that you're getting $5,000 in market rents, same math, 75%, $3,750. means that you would be able to qualify for up to $6,530 principal, interest, taxes, and insurance. And again, the way that we're getting to that is your $7,200 plus that $3,750, which is 75% of the rents you would be expected to be receiving, means you could qualify for a 3-unit for $1 million, whereas with the 4-unit, up to 4.2. So that's assuming $8,500 in market rents. And then, so this is just the math breaking down. So in theory, or in essence, single family house, you could qualify for less than $5,000 a month in mortgage. Fourplex, over $9,000. So there's a big spread there. Almost double the house. In fact, double the house value based on income and market rents. So that's the power of using 75% of the gross market rents towards your debt to income. And that's just one of the reasons the VA loan is amazing. Top 5 things you can do with the VA loan, and you're going to want to stick around to the end because I'm going to talk about how to build wealth with it. Number 5 is the VA renovation loan. And yes, we're just jumping right in, right? So for some reason, a lot of people don't know about this. It's been around now for 6-7 years. And for some reason, people just don't understand that the VA loan has a renovation option. Now, the reason is that most lenders don't offer it. It's just not the most commonly used thing. So I'm not gonna elaborate a ton on this, but you can buy a house that needs to be fixed up, have it fixed up, move into it, all paid for, zero down by the VA loan. So it's like the FHA 203K loan, but better. And yeah, it is phenomenal. So that's number 5. Number 4, and this is as of January 1st, 2020, you can buy $1 million house, zero down. You can actually buy a $2.5 million house, zero down. You can buy a $20 million house, zero down, provided that you qualify for the mortgage, right? So you have to have the income and the credit and the debt to income ratio and all that other stuff to actually qualify for the mortgage. But with the DTI for VA loans being higher than 50%, in fact, there's no actual limit by the VA, just by lenders. It actually affords you more purchasability anyway, but I got a phone call once, I'm not gonna name the gentleman, who called me to thank me, essentially, because he had stumbled across one of my articles. Not stumbled across, I think he went and looked on my website to see if there's anything about this. He bought a $2.5 million house in Dallas, zero down, and he was gonna pay the 20% down payment. So effectively, we saved him a $500,000 down payment. Now, obviously, this is somebody who has some money, is well off, but that's still a lot of money saved, opportunity cost and all that. And he locked it in with an incredible interest rate for 30 years. So awesome. So there is absolutely no limit to how much you can buy on your first use with the VA loan, zero down. Now, there's a lot of stipulations after that, but the long story short is if you refinance or try to sell the property to your LLC, you don't regain that full entitlement. But if you sell the house, you actually done. Like, you no longer have any ownership interest or trust or anything with that house. Your guarantee is not tied to it anymore. Then you can reuse the zero down, doing that as many times as possible. Otherwise, it's a one-time restoration. I've got other videos on that. It's a little bit more complex, but suffice to say, zero down, expensive house, pretty fucking sweet. In that same regard, number 3 is you can use it multiple times. I know somebody who's had 4 VA loans out at the same time because they were affordable enough properties. Now, I also know people who've had one and then they sell it and they buy another, or they have 2, or basically it all comes down to your entitlement. So if you have questions about your specific scenario, I always recommend talking to a lender because it's going to be different for every single person depending on your first purchase price, the new county loan limit where you live currently, and several other variables. So if you're looking to buy a second house or third or fourth or fifth with a VA loan, recommend you talk to a lender, and there's a link down below that we can help you out with just asking that question. Number 2, you can build a home with the VA loan and it's still 0 down. So yeah, that's right. The one-time close, essentially you can buy land, build on it, and move into it for free. I don't know any lenders will do a 4-plex this way, or triplex or duplex or anything, but I do know that you can build with like a normal loan and then refinance, cash out refinance into a VA loan if that's the way you wanted to go. But as far as like building a single family house, you can do that. You can even build a barn dominium with the VA loan. So lots of cool stuff out there, and I definitely recommend that you do some homework. And again, you can ask those questions. All right, here you go. Number 1. The number 1 thing you can, and I would say should, do with the VA loan if possible, and this is how you, like, the best, fastest way, I think, to build wealth with it: house hacking. So you go and buy a 4-plex, 0 down, you live in one unit, you rent the other units, your tenants pay for all of your living expenses, and now what you would have been spending on rent and or mortgage, you can pocket to invest, and you're still paying down principal, but your tenants are paying it. Let's say your mortgage was $1,000 a month, that's $12,000 a year that you can now invest. That is, if it's $1,000 a month market, that might be a down payment on a new house. If it's a $2,000 a month down payment, that still might be a down payment on a house because you're saving $24,000, and $2,000 a month in rent, average home price is probably around $200K. So there's a good chance that in 1 or 2 years, off just the money that you saved in rent or mortgage, you could buy another house with a full 25% down payment, right? And that's awesome. Not only will you learn how to be a landlord, get the tax benefits, benefit from any appreciation that happens with the house while you live there, and be getting to live for free, but you're going to be able to save more money to invest to multiply. And when you move out, that house, if you've done right, should cash flow and pay you to own it while you do the next house. So you can do this more than once. You can rinse and repeat. I know people who bought several 2 to 4 unit properties with the VA loan. It's phenomenal, and I definitely recommend that you do it. So long story short, guys, with the VA loan, you can do almost anything. The VA has very minimal criteria. If a lender is telling you no, it's most likely because they don't fully understand the VA loan. Or an agent tells you no, it's most likely, or that it's not competitive, that they don't understand it. And unfortunately, it's easier for these professionals to push you to a product they do understand than to learn how to use the VA loan. 5 things you cannot do with the VA loan. Number 5, as I look over at this screen, you can't buy an investment property, right? Like, you can't just go and buy rental properties with the VA loan. Now, there are ways to invest with the VA loan properly, like house hacking. Not going to elaborate too much, but you cannot buy just a strictly rental property, house flip, investment property. It has to be a primary residence. That's it. In that regard, same vein, number 4, can't buy a vacation home or second home. Again, has to be your primary residence. Now, if you move somewhere that you would like to have a vacation home and you live in that house for a while and you occupy it as your primary residence, and then one day you move out, you can still keep that house. Now, you can't just we'll get into this in a minute, so hang on. Number 3, you cannot complete the work yourself on a VA renovation loan or a new build. And I know there are people who get upset about that, but think about it. The bank is lending you money and they're betting on it. They don't want you cutting corners to save money on a property that they lent to. It is not in the bank's best interest to let you do the work. It is not that you can't do the work. It's not that you might even be a licensed VA contractor approved by the system to do renovation loans. But if it's your house, sorry, there's too much temptation and humans suck. So that's what the bank is betting on. You not sucking, or you sucking worse than the other people. Now, that might not be true. You might be better. You might care about the house more. You might whatever, but somewhere along the line, someone fucked it all up. So just deal with it. It is what it is. No amount of whining, complaining, or whatever is going to get around it. So nope, don't worry about it. Number dose. You can't use any lender. Now, that's actually not true. You can, but you should not use any lender. They're not all created equal. So let me tell you how this works. For reference, I am a licensed real estate agent and a licensed loan officer who has never transacted either because I don't care to get sucked into the business of actually doing loan applications. I have an entire team that handles all of that for me. And I've never sold a house as an agent or bought a house as an agent because, again, I don't want to transact. I just want to make some introductions. Yes, I get like a 25% cut from an agent if you use one of them, but they're also friends and they're the best agents out there. Not all lenders are created equal. And here's what I mean by that. When you get your loan officer or agent or whatever, like classes and education and all that shit, they literally just talk to you about like the basics of the program. You have to understand the basics of the program. 0 down, backed by the VA, like how it works, whatever. Enough to not get in legal trouble. They don't teach you the nuances. So the problem with all these big bank lenders or even small bank lenders is if you don't do a ton of VA loans, and that's not what you decide to focus on and learn about, you don't know diddly about it. The VA is very intricate. It has looser restrictions than virtually any other primary residence mortgage in existence. And there's more that you can do with it than any other loan. But unless you read the guidelines or specifically research the VA loan time and time again, and you talk to the underwriters, you're not gonna know that. But the problem, and here's the catch, if I'm a lender and you're bringing me business, is it in my best interest for a paycheck to A, say, I don't really specialize in the VA loan, go talk to another lender, or to B, either do the VA loan with substandard service and not tell you that I don't understand it, or C, push you to another loan product that's not as good as the VA loan because I do understand that loan product and I can feel like I can give you better service. Yeah. B or C, right? They will either do the loan themselves and suck, or they will push you to another product and convince you that the VA loan sucks. So that's where we end up in this world where like agents and lenders are like, the VA loan's not competitive. No, you just don't know what you're doing, and please step aside and let the veteran use somebody who does. Rant over. There's no better product out there than the VA loan. There's not. My buddy Brian Lubin sold a bunch of houses, and the only 2 that have ever come in at appraised value to a seller or to a buyer were both VA buyers. So best appraisal process, best appraisal rebuttal process, Tidewater, and going directly to the VA. It's the only, so my lenders tell me if you're buying a house and there's an issue with the appraisal, they've got like a 60 to 70% approval rating for overturning that appraisal by going to the VA, because the ego of the appraiser doesn't get involved because it goes over their head to the VA. They have like a 0 to 5% approval rating for doing that with any other mortgage product because it goes directly back to the same appraiser who's gonna be like, I didn't make a mistake, my ego is involved. So anyway, I could go on and on and on and on about this, but the long story short is not all lenders are created equal, which is why it took me years to create, cultivate, build, whatever, the right network with a team that I trust. And so nationwide, they do one of 2 things. Either if they're licensed in your state, they can handle the loan and they're freaking rock stars, or they will make the introduction, if it's a state they're not licensed in, to a vetted VA past approved broker. And vetted VA is the #1 training platform for VA lenders who will absolutely take care of you. Right? So they will either do the loan themselves, or they'll just introduce you to somebody who's been trained through this incredible training platform where almost nobody passes. In fact, I don't think anybody's ever passed the VA loan knowledge test on the first try, to make sure that you get a proper introduction, right? So that's awesome. If you want one of those intros, click the link down below. I'll introduce you to a lender or agent or both. All right, the #1 thing that you cannot do with the VA loan is intend to occupy, i.e. commit mortgage fraud. Right? And for reference, mortgage fraud or occupancy fraud is up to a $10,000 fine felony charge. Right? So like, it could be 2 years in jail, it could be 10 grand, felony, can't vote anymore, can't carry a firearm anymore. Like, you tell me if that risk is worth the reward of buying a house just because you want to buy a house and try to game the game and not live in it as primary, when you could A, live in it as a primary, or B, just use a different loan product to buy said house as an investment legitimately instead of trying to skirt the down payment to make a 0 down investment purchase, right? Go back to #5, cannot buy an investment property with a VA loan. So when I say intend, okay, the clause says you have to intend to occupy the home as your primary residence. What that means is you need to no shit plan on moving into the fucking house unless some crazy circumstances change after you close on it. So like, let's say you're under contract, you close on the house, and then you were supposed to get stationed in Pensacola, Florida, and you close on the house and boom, you got orders to DC now. They changed your orders. That is a perfectly understandable and legitimate reason to not actually occupy the house. My buddy Tim was renovating a house, and it took like 6 months longer than it was supposed to. And at some point, when their lease came up for renewal on their rental property, they just moved into another property. And then they were like, oh, we got a year left on this lease, we can't break this lease, like whatever. And they ended up not occupying that house. They intended to, but it took like a freaking year to finish the renovation loan when it was supposed to be like 4 to 6 months. So they had a 6-month lease, then they had to sign a 1-year lease. It was just this whole thing. I've got 2 other buddies who bought a triplex together, and then it had 3 units, and one of them was occupying, was going to be vacant the week they closed, right? It was supposed to be vacant, and the tenant was moving out. And no big deal, right? That's legit. You can have a VA loan as long as, on like a triplex or fourplex, as long as one of the units is unoccupied or will be unoccupied when you get there so that you can move in. This was in 2020, and guess what happened in California? COVID, right? I mean, it happened everywhere, but in California, good luck evicting anyone. Total moratorium on it. And so this tenant didn't want to move out. Changed his, he was like, oh no, I'm gonna squat. And they spent like 8 months trying to get this dude out of the house. Never could get him out of the house. And they ended up just selling the house, and they profited on it, and they never moved into it. But you see, what all of those have in common is that they wanted to live in the house, intended to live in the house, and then something crazy happened. And there are other situations, right? Like if you buy a house that's like a 2-1 or a 3-2, and then you have twins, and you already had a kid, like whatever, you might need to upgrade to a larger house. If, let's say you buy a 2-story house, and then you have a work injury and you can't go upstairs anymore, you might need to move somewhere else. Like, there are legitimate reasons for being able to buy a house that you either never occupy or don't occupy for long. But what all of these have in common, every single one, is that you were not planning ahead of time for a reason to move out of the house. The moment you have a plan, like, well, I'll just buy this house and then we'll have a kid immediately, like we're already pregnant, I'm gonna buy this house, and then I'm gonna say, oh, we had a kid, we need a bigger house. Or I already have orders to PCS out of state, and I'm gonna buy a house here knowing I'm already moving. Like, it's one thing if you don't have orders and it's just the rumor mill, because that shit can change all the time. But if you have orders in hand, you're not gonna be able to, like, you can't legitimately say you intended to occupy the house if you're like, oh yeah, I have orders to leave in May, let's buy this house in March, knowing we're leaving. Like, those games are what's called mortgage fraud, occupancy fraud. You never really intended to occupy the house as your primary residence. That wasn't your purchase reason. You were trying to game the game, get yourself a rental property for 0 down. Now, I respect the hustle. I get it. And there's gonna be all these comments in the whatever that are like, oh, but Dave, I get it. I respect the hustle. It's not worth the risk. Going to jail, losing your rights to vote, carry a firearm, being a felon, to buy a fucking house? Are you kidding me? I love real estate. It ain't worth that. I am not gonna open my drawer to say I love my because, YouTube will probably be like, ban your video. I definitely don't have anything that would look suspicious in a constitutional carry state where I would conceal while I'm walking potential properties in crack neighborhoods. Definitely don't. So forget all of that. So that's the bottom line here. It's not worth it, right? And they do catch people. Now, is it often? No. Are they gonna like check on your house all the time? Probably not. But if you miss a mortgage payment and they find out, not good. Like, the VA does catch people. People do go to jail for this. People do get the fine. People do get the felony charge. It does happen. It's not worth the risk. Just buy a house that you plan on living in. So that's my number one, right? That's my rant. Why the VA loan is the best primary residence mortgage in the world. Right, so the first thing, interest rates. They're better with the VA loan. They just are. And there's a couple reasons for this. One is loan level adjustments. So a VA loan won't adjust on your interest rate for the first time until you get a 640 or lower credit score. Whereas FHA, conventional, and other primary residence mortgages will adjust 3 times before they hit 640. So if you have a 800 credit score and I have a 650 credit score with the VA loan, we're gonna have the same interest rate. And if you have an 800 and I have a 650, I'm gonna be like a half to a full point higher interest rate than you on any other mortgage product, which does 2 things. 1, it means your payment's higher. 2, it means the amount of home you can buy is lower, your affordability. Also, VA loans have a half a point lower interest rate out the gate on multifamily. So FHA and conventional loans, you get penalized for buying a duplex, triplex, fourplex. You'll have like an extra half to full point of interest, whereas with the VA loan, you don't, right? Now, also the VA IRRRL, which is interest rate reduction refinance loan. So like in today's environment, that means that if rates drop over the next 6 months, 210 days or 6 monthly payments by the time you're eligible. So let's say a year down the road, rates dropped all the way down to 4%. You could just file a piece of paper and refinance. You don't have to live in the home anymore by then. You don't have to have your credit checked. You don't have to do an income verification. You could have the house rented out and be totally jobless and still refinance and lower the rate. You can't do that with any other mortgage product, and that's incredible. So I love that. Also, just to prove my point, somebody I was coaching yesterday just locked in a house with a VA loan at 6.55%, and you're not getting that on most loans right now. So, and they had good credit. All right, so with the VA loan, you can do a construction or a rehab loan. They're not necessarily the easiest things. Most lenders don't know how to do them with the VA loan, and so lenders will tell you they don't know how to do it, or they won't tell you that. They'll tell you it doesn't exist, but that's not true. They just don't know how to do it. Those are both things with the VA loan. You can do a renovation, like an FHA 203K, or you can do a construction loan where you build a house. Both are possible with the VA loan. Don't let somebody talk you out of it. If you have issues finding someone, hit me up. I'll introduce you to an agent lender that can help you with that. Oh yeah, you can use the VA loan multiple times. Now I know people for the most part know this by now that you can use it more than once. As long as you're within your entitlement. I have a friend, Naaman, who owned 4 houses with a VA loan all at once, and they were just low enough in purchase price that he was able to pull that off. That's not really the case for everybody, but you can do, like, let's say you hit your entitlement, you can sell all your properties, restore your entitlement and go again, or you can refinance them all into conventional loans and do what's called a one-time restoration of benefits, and then you can go again. But I'm not going to go too much more in the weeds on that. What I normally tell people is after your first house, when you get ready for your second, third, talk to a lender. And again, I've dropped a link down below for lenders you can talk to that I recommend, and they are going to be your best source for figuring out all the ins and outs about whether or not you can buy another house and how much you qualify for, because it really does vary every situation based on purchase price of the first house, purchase price of the second house, and your county loan limits, where you live at the moment, where you're buying, all that stuff. And so it's just a variable. It's beyond the scope of this video. So let's see. No mortgage insurance premiums or private mortgage insurance. That's MIP, PMI, which will exist on any loan you pay less than 20% down on other than the VA. So FHA, conventional, USDA, any of those, you're paying MIP and PMI, and they cost a fortune. For example, I was paying $81 a month on a $79,900 duplex that I bought in PMI, and that was after paying the MIP. But that PMI was $81 a month. The VA loan, it would have been nothing. And even with the funding fee that people rant and rave and they like to pick it as the one negative thing about the VA loan, that would have been like $11 a month instead of $81. So not even close. It's like $11 a month for every $100,000 you borrow is what the funding fee comes out to. It's actually like $10.5 now because they lowered the funding fee, so it's actually like $10.50 instead of $11 for every $100K that you borrow. That's nothing compared to all the other PMI stuff. And then on top of that, that's waived if you're a Purple Heart veteran recipient while serving, or if you have a 10% or higher disability rating once you get out, which most people do. And before you go off in the comments about how corrupt the funding fee is and oh my god, the funding fee is terrible, and you focus on the only negative thing about it, the VA wouldn't be able to stay open and keep this product alive if they didn't have that, because they have to pay all their employees for processing loans and backing loans and the whole system. So that's how they do it. So it is what it is. Still better than any other product in that regards. Oh, it's assumable. So you can assume a VA loan, and you can actually have a non-qualified VA user assume the VA loan. You just lose, you don't regain that entitlement until they pay off the note. But as a veteran, I could assume a VA loan, no problems. I mean, it's a long process. So I say no problems. It's a complex, lengthy process, but it can be done. The appraisal process for the VA loan is better than the appraisal process for any other mortgage. So with a VA loan, the appraiser can do what's called tidewater. Basically, they can give you 48 hours to say, hey, provide me with comps if you think that your comps will sway what I'm going to put down on this, because I think I'm going to come in low. That's not normal. And then if they do come in low, you can go directly to the VA and be like, hey, here's the comps we found. We don't think this is an accurate appraisal. And I'll tell you that my lenders I work with say they see like a 5 to 15% approval rate on turning over appraisals with other mortgages, and it's like 60-65% with the VA. Incredibly higher likelihood, and there's actually a way to rush that, and that might even improve your chances, but that's like a case-by-case thing. But the reason for that is that if you, like a normal appraisal, when you say, oh, I don't think this is right, here's all my comps, it goes back to the appraiser. And then they're like, oh, you don't think I know how to do my job, like their ego's in the way, all this stuff. It's very rare for them to say, oh yeah, you're right, I messed up. But if you go through the VA, you just go straight to the VA, and that appraiser never even knows that it happened, which is pretty sick. There's not a debt to income requirement. So like FHA, conventional, all this stuff, if you break 49%, so like once you hit 50% debt to income, no go on that loan. I've seen someone close a VA loan with like a 75, 78% back end DTI. I'm not saying I recommend that, but it's doable, right? There's also no credit score requirements. I've seen people with the VA buy, 540, 580 with the VA loan, and you're not going to see that with most loans. So also no credit. And here's the thing to remember: when you're working with all these lenders, if a lender tells you it can't be done, ask where that's shown in the guidelines. Because a lot of times, like, this is why it's so important to work with lenders that really specialize in the VA loan, because most lenders don't specialize. They just like learned a little bit here and there. But if you truly specialize in the VA loan, which is why I say just go click, talk to the lenders that I work with. They're more knowledgeable than anyone else. They run a training program called Vetted VA. They're incredible. And if a lender tells you that you can't do something with a VA loan, I'd say 9 times out of 10, 8 times out of 10, it just means their bank won't do it. And rather than saying, our bank won't do that, go try this one, they're just gonna say you can't do it. Because they, maybe not ill-intentioned, maybe they just don't realize that because their bank has an overlay that says you can't do it, other banks still can. Which is why you gotta know what's in the guidelines, vice what the bank is telling you. Because if it's in the guidelines, okay, yeah, you can't do it. But if it's not in the guidelines, it's fair game. Like, there's no credit score requirements. So you just gotta keep asking around until you find a lender who will give you a loan. Because they can, the VA will back it, which makes it safe for the lender. As long as the lender doesn't have a minimum credit score requirement that they overlay on top of the guidelines from the VA. So I tell people all the time, whenever you run into an issue where you're not 100% sure if the lender's being honest with you, ask about and check the guidelines. And if that doesn't work, come talk to one of my lenders and they'll square you away because they're the best. So it's easier to qualify for a VA loan than like anything else. In fact, I'm gonna mess up all these numbers on it, but I mean, it's absurd to think, like, I think it was like every 100 people that applied for the VA loan, like 40 something bought a house last year. So like that means 60-70% were qualified and like 40 of them actually bought a house. I mean, it was a crazy number. I don't remember the exact stat. I'll have to go look. It was at a conference I was at with the actual VA, and it was phenomenal. There's all kinds of stuff you can do with the VA loan. Oh yeah, they count 75% of the gross income of your tenants towards your rent. And if you don't have the 2 years experience as a landlord, just hire a property manager. So the VA guideline actually just says you have to have a likelihood, like a high likelihood of success as a landlord. You don't have to have experience. Someone's telling you you have to have experience, that is a lender overlaying that again. So just hire a landlord or go find another lender, because you don't have to have experience. You just have to have a high likelihood of success as a landlord. I would say any service member and veteran has a high likelihood of success as a landlord if they put their mind to it, because you made it through all the crap that comes with being a service member and veteran. Being a landlord's not as I don't actually know which one's worse than going through like boot camp and getting shit on, or dealing with tenants. They both have their ups and downs for sure. But biggest thing with this is agents and lenders get taught that the VA loan exists and like the super basics, like 0% down, it goes through the VA, blah, blah, blah. They don't get taught the specifics. So you need to go to somebody who actually took the time to go through the guideline and learn this stuff on their own, which is hard to find. And that's why I keep going back to it. But if you click the link down below, you'll get an introduction to an agent lender that I work with in the area you're looking to buy. It costs you absolutely nothing. If you do buy a house with that agent, just for full disclosure, I'll get a kickback, but it'll be from the person selling the house. Whatever. You're not gonna pay me, and so it'll cost you nothing to get introduced to an agent lender that actually knows what they're talking about, as opposed to one who like says they do but just doesn't want to lose your business, isn't gonna tell you like, I'm the wrong person. I'm really not that great at this. You should probably go work with somebody who specializes. Like, no lender's gonna tell you that to turn you away.
Co-signers and co-signing, and why you should never co-sign for anybody, because it's terrible, and the risk you take for no reward other than saying, oh, I helped someone. It's like oh my gosh, it's such the number of people who have been ruined by co-signing for someone that they loved. Because the thing is, it doesn't matter that they have your best interest at heart, because the people who need you to co-sign for them are people who have proven track records of not succeeding. In this instance, this would be like an Ironman athlete who has a really overweight brother, and the overweight brother is like, yo, I need this really attractive girl to date me, so I need you to go on a date for me. But here's the kicker: if she finds out you're not really me, they're gonna behead you. So like, you're just gonna have to keep pretending and hope that you don't mess this up. No big deal though, because like in the end, I'm eventually gonna lose the weight, and then we'll just be able to switch places. And if that works, nobody will ever know. And if it doesn't work, well, I won't get in trouble, because they'll never know I existed. So, like, I know that's a terrible analogy, but like,
dude, there's no reward for the person who's co-signing. Like, there's not. They don't get anything. They're co-signing. But the risk is there. They take all the risk. Anyway, so I'm going to show the clip that I made about why this is bad. And then I'll show the clip. And for reference, this is not me just saying I'm going to go tack ADPI and active duty passive income and whatever. I make these videos all the time where the I don't want to say like fake guru math, but that's kind of what people are calling them, where I disagree with the logic behind something, and I'm going to point out why. Here's why you should never co-sign, and it's going to hurt. Rip the Band-Aid. Look, I don't care how much they love you. I don't care how much they have your best interest at heart, because yes, it doesn't matter. It could be your girlfriend, it could be your wife, it could be your mommy, your son, your grandparent, your pastor, I don't know. Anybody and everybody who you think is the one person who loves you more than anybody else and would never do you wrong. It doesn't matter. That's the problem. The problem with co-signing is that it doesn't matter how much they love you and how much they want your best interest and have your best interest at heart. Because if they make a mistake, it's on you, right? So think of it this way. If a bank wouldn't lend to you, why should someone else, right? Like, if a bank wouldn't lend to them, why should you risk it? And the problem is that if you co-sign for someone, no matter how much they love you and have your best interest at heart, if they default on that, or mess up, or get in trouble, or get hit by a car and don't have insurance, or like something that's unforeseen or whatever goes wrong, it's on you and you're going to get stuck with it. So the risk is not worth the reward. You stand to gain nothing. By co-signing, you gain absolutely nothing. You have no reward, no benefit at all to co-signing, but you have a risk. It's not worth it. The name of the investing game is not to gamble on risks with no rewards. It's to bet on things with massive upsides and minimal risks, right? So don't co-sign. All right, so there are my thoughts. Now let's watch the video and react.
Hey guys, Mark Yancich here with ADPI, and today we're going to be talking about how to use a co-signer to buy a home with your VA loan. Have you ever thought to yourself, man, I want to invest in real estate, but my credit's just not good enough, and I don't know that I'm ready to take on this much debt?
Okay, let's stop it right there. If that's you, the right answer is work on your credit, work on your risk aversion, because guess what? If you want to invest in real estate, you're going to have to take on debt, and you're going to want to improve your credit. It's how you invest in real estate. If you want to invest in real estate without improving your credit and without taking on debt personally, be an LP investor in syndications. Be a private money lender. Find a way to invest in real estate where you're not taking on a mortgage and you're not doing the things. But that way is not buying a house. Because if you buy a house, you're going to need credit and you're going to need debt. Unless you're doing seller financing, then you might not need credit, but it's still going to have debt, right? The seller financing. So like, this isn't a have a cake and eat it too thing. Like, you need to have credit and debt. Like, again, as I've said throughout all of my investing, whatever, your finances need to be in order. If you do not have your finances in order and you think that buying more real estate to get your finances in order is the answer, you're setting yourself up for failure. Take the time to pause and build that foundation, then go in on real estate. Having bad credit, terrible debt, not being able to take on more debt, bad financial foundation, and then buying real estate in hopes that it'll fix your foundation is setting yourself up for failure. It's just not a good mix. Sorry.
Well, that's exactly where co-signers come in. So if you're someone in that...
For the reference, this means bad credit, don't want to take on debt. Let's ask somebody else to say, hey, my credit's bad, I don't want to take on debt. Can you take on the debt for me and sign saying that my credit sucks so you're good with covering for me? Yeah? I'm going to have the house, I get the reward, you're going to take the risk, so if I default, it's on you? Cool? Yeah, we're good? Cool, thanks.
A co-signer is just somebody that basically lets you use their credit. You can even think about it as if they are loaning you their credit. This might be extremely
Asking them for
beneficial
their
for you
credit.
if you're someone
That's
who
the risk.
either A, has bad credit or is in a bad financial situation in general.
Again, shouldn't be
Now, you don't
buying a
want
house.
just anybody to be your cosigner. You want it to be somebody that you're comfortable with. And here's the 3 things I would typically look for if I were you. 1, make sure that it's somebody just you trust, like point blank. 2, make sure they have good credit, duh. And then 3, make sure that it's somebody that they genuinely want to help you, okay?
For reference, the person in this scenario who should actually be doing the vetting is the cosigner. The person who's getting cosigned for could just run around screaming, "Will somebody please cosign for me?" Because anyone who says yes there's no risk for the person being cosigned for. Once they sign that, you're good. You can basically do whatever. The person who's co-signing is the one who needs to do the vetting. That's the person who's going to get stuck and screwed if this goes south.
Be begrudging
See it
you
all.
or asking you a million questions after this all happens. Now, the reason why you want it to be somebody that you trust is because they are going to be providing their own financial documents to acquire the loan for both of you, essentially. And they are going to be assuming the loan if you default on it or if you stop making payments. Guess what? The buck stops with them. They are ultimately the ones responsible for making sure the payments continue happening. So let's just break down the benefits of a cosigner. First things first, you might be able to get approved for the VA loan that you are eligible for.
Note that he said making sure the payments still happen. He omits, and I know this is not his intent, because it's maybe we get to it in a minute, but omits. It makes it, when he says that, what he means is if they don't make those payments, that's the person who takes the ding on the foreclosure, right? You both do, but that's the person who gets screwed, right? They didn't buy the house. They didn't get the benefit. They either make the payment or they're signing to help you ends them on the foreclosure as well.
Which is huge. That's a very, very big benefit. And secondly, a cosigner might help you get approved for a larger loan. Now, I'm not talking about getting into debt, bad debt on a bigger loan. I'm talking about actually acquiring more good debt because you're buying a home that you can potentially house hack, or it's going to have a big return on investment when you make it a rental down the road, all those types of things. So
again, that only makes sense if the property itself actually makes sense. The idea that you couldn't qualify for the loan, somebody else can help you qualify for the loan via co-signing, therefore it's good debt just because it's a house. There are ways to do it without a cosigner. Again, if your finances aren't ready to buy a house, then buying a bigger house just because the numbers might make sense down the road, I don't think constitutes good debt. Sorry. I think that if you're not ready to be buying a house and the bank is not willing to lend to you without someone else's signature, then you should probably just hold off. You can house hack without buying. I house hacked a rental. I Airbnb arbitraged bedrooms and lived for free basically in San Diego and pocketed my VAH. It was great. And I could have done that with no credit and it would have been awesome.
this is where like the long game can really be beneficial. All right, well, what's the difference between a cosigner and a co-borrower? Well, now that you're pretty crystal clear on what a cosigner is, I want to go over what a co-borrower is, and I want to make sure that you do not get confused between the two. Here are the 4 main elements of a co-borrower, all right? 1, a co-borrower is when both of the borrowers are making the payments, or basically pay on the loan. 2, it's a mutual application. Both of you are applying for the loan. 3, you are mutual owners of the property. And 4, this typically is when it's like a spouse or partners. This is when you see it the most often. Now, if you watch this and you're like, okay, I really want to do all that, but it seems like it could get hairy if I'm not careful and I need a good lender and agent to walk me through, you're absolutely right. You always want to have people that actually know what they're talking about, especially with the VA loan.
So this is basically a 3-minute video that says, hey, if you have no credit and bad finances, then we're going to make a video. It's a 4-minute video, but whatever. Hey, we're going to make a video for people with no credit and bad finances to teach them how to convince people to co-sign for them. And then, I guarantee the last minute of this is them pitching their lenders and agents so that you can come, shameless plug, use their team to convince people to co-sign for them. Just don't. I mean, don't get me wrong. Like, oh, shameless plug, I know agents and lenders too, and I'd be happy to recommend them to you. But my agents and lenders would hopefully tell you that you should probably fix your credit and work on your personal finances before you look at buying a house. Because So for one, I prefer the co-borrower idea to the co-signing. My buddy Donnie and Adit, they co-borrowed together. One of them had used his entitlement and the other had entitlement. And the one who had entitlement couldn't, his income was huge, but it didn't have the 2-year requirement, so it didn't count. And the other one met the requirement for income. So they were able to combine, bought a fourplex in Imperial Beach, made a ton of money, crushed it in the San Diego County area. And they were able to do that together with one of them having entitlement, one of them not, and one of them had the other one having income and not, and they came together, bought a triplex, I guess, actually, and crushed it. And that was awesome. And so that's a win-win co-borrower, both risk, both reward, boom. Spouses, co-borrowers. I mean, there are some really awesome situations where co-borrowing is just a great way to be. Every now and then you hear of a situation where people co-signed and it was great. But I think for every one time that I hear about that, I hear about 8 to 10 times where it goes really, really bad. I mean, it's super skewed, right? And I'm sure that means there's probably a few times where it goes right and nobody says anything.
I am coming from a seller's point of view and why it is so important to have a really good, solid agent. So I was trying to sell my Florida house. I listed it a year ago, and my house went through 2 agents before I found Dave. It wasn't budging. It wasn't selling. One of those agents told me to just walk away and foreclose. And when I was told that, that's about the time that I found Dave and I shared my situation. I was making 2 mortgage payments. I was trying to carry 2 houses. My Florida house isn't selling. I want it gone quick. And Dave made a really solid connection with one of his agents that's in his war room, James Lascara. So within 24 hours, I'm on the phone with James. James listens to my goals, puts this house back on the market. And within 2 days, we had an offer above asking. The buyer was cleared to close in 8 days, and then we closed, I think, a week and a half early. I mean, just absolutely crushed it. And I could not have imagined that was going to happen. So, I went from my house sitting on the market for a year, making 2 payments, 2 different mortgage payments, being told to foreclose, to making a connection with Dave and being out from underneath this house within 3 weeks with an above asking offer. I mean, I can't say enough. Dave is amazing. His people are amazing. His group is amazing. They're absolutely solid. I would highly recommend them. And I definitely know who I am coming back to when I'm ready to move again. Thank you so much, Dave.